Thursday morning. As we approach, of course, the payroll number tomorrow, that is the other thing that we're going to be watching for so carefully. FTSE 100, flat as a pancake. We'll dig into the details of that in just a moment. Obviously, we are seeing some changes there as well. Spanish market, flat as a pancake. Stock 600, flat as a pancake. Stability, maybe the order of the day. Everybody is just going to start holding their breath now, waiting for that payroll data, but keep an eye on that ISM figure as well out of the United States. What's the inflationary picture out of that? What's the payroll picture out of that? You've got ADP coming up. There's a few there's a few elements of turbulence that are still going to be on the docket today. But at the moment, it looks like equity markets are fairly calm. The CAC has yet to open. The DAX has yet to open. The SMI, with inflation kind of near zero in the Swiss economy at the moment, yet to open. So what are we seeing in the sector story? Individual stocks as well. What are we watching? Val, Tom?
Well, at least when it comes to the technology sector, it's at the top of the basket this morning. So I guess not very much swayed by the miss in the Salesforce earnings overnight out of the U.S. We have SAP trading in the green as well. At the bottom of the basket, we do have travel and leisure. It seems like EasyJet at the open, those shares are down some 4%. So that's leading the declines for the sector. Travel and leisure at the bottom of the basket. But it is fairly even when it comes to the split of the sectors in positive and negative territory this morning.
Yeah, so your point, Val, the airlines are under pressure, it seems, and so the standout in terms of the downside is travel and leisure down around 1%. On the upside, media just up 0.5%. Tech, to your point, a little in the green as well, just up 0.4%, despite the concerns around Salesforce stateside. In terms of some of those individual names, of course, Burberry re-entering the FTSE 100. I haven't print on Burberry quite yet. But in terms of the gainers, Embracer Group is up 3.6%. Dassault Aviation, so some of the industrial names are gaining as well. AP Moller-Maersk in the shipping space getting 1.7%. On the downside, you do have those airlines. Ryanair now down 2.7%. EasyJet down 3.6%. So a gauge there as we look at the bond markets opening as well, with gilts also in stable territory so far.
I just want to check what the ex-divvy list looks like this morning and make sure EasyJet's not on it. Doesn't appear to be, according to my list. It's Thursday in London, which usually means ex-dividends. It's Admiral, Antofagasta, Derwent, Kingspan, Land, Securities and Pru. So I don't see EasyJet on that list on this morning. So I'll dig into that and find out what's going on.
Yeah, still some interesting stuff going on under the hood, though equity markets are trading pretty flat. We do have S&P 500 futures just slightly in the green, up 0.1%. But joining us now to discuss equity markets and macro more broadly is Frédéric Carrière, the head of investment strategy for the British Isles and Asia at RBC Wealth Management. Thank you for joining us this morning. What do you take of this market? I know we're back to school, first week of September. We got the big payroll print tomorrow on the horizon. Are you bullish or bearish to start this month?
Look, we've had a summer where a lot of the risks seem to have been ignored, and so the market is a bit more nervous this week. All eyes, of course, are on the figures, the non-farm payroll figures tomorrow. We expect about 64,000 new jobs, so just a little bit below consensus. We're mindful that now that the trade uncertainty has largely passed, there might be a bit more hiring, and we'll be looking very closely not only at that number, but what makes up the number. Is it mostly from the healthcare sector? How about from cyclical sectors? And that will give us a sense of the health of the U.S. economy. And of course, we'll be looking very closely also at the revisions, given that there's a new head of the Bureau of Labor Statistics.
You know, we also have the inflation data for the U.S. next week as well. We had a previous guest come on. It was Pooja Kumar from TD Bank saying there's really nothing in the data this week that would sway her opinion the Fed is going to cut in September, given what Powell told us at Jackson Hole. Do you share that kind of opinion?
we're waiting for the numbers tomorrow. If they're not conclusive, then the CPI number in September will be very important. And as part of the difficulty of the macro data which is coming out at the moment is that you can interpret it both ways. So we need a bit more data to know. We do expect for sure a cut in December and probably one in September. We concede that the risk is for a September cut.
Given what's going on at the moment, equities, you could argue, are fully valued. You've certainly got multiples at very elevated levels versus historical context. You've got a bond market that seems to be quite choppy. From a kind of wealth management, investor, asset management perspective, do I just buy dips? Is that still the strategy? Just wait for a moment, take that moment. You've just seen a huge turnaround in UK long-dated bonds, for instance. You could get volatility in the equity market around some of this story. Nvidia's been fairly choppy over the last. Is that what I'm doing right now? Just waiting for a better entry point and then putting money to work? Is there a kind of bigger picture story here, or is that tactic still the way to go?
We agree that from an asset allocation point of view, it's difficult to be excited at the moment on either equities at 24 times. Yep. Earnings in the US. We are neutral, all regions. In terms of the bond market, government finances make you not want to invest heavily in bonds. Credit spreads are very tight as well. So you have to work really hard. You have to be very dynamic, focus on areas where you have very strong conviction. And if you have the right risk profile for wealth clients, perhaps liquid alternatives are an area, particularly infrastructure, where cash flows are indexed to inflation, but really high conviction and be very dynamic, very important. Okay,
so you want to be dynamic. How many of your investors' clients are buying gold right now? And why are they buying gold, I guess, is the other question.
So the ones who are buying gold are focused on the US dollar weakness. They want a safe haven. And we do expect that gold prices are likely to gain more, particularly if there's another macro event. So our price target is for north of 3,800 per ounce for next year. And we're getting there. It could be higher if there's more need for a safe haven.
It's interesting. Goldman Sachs, the note that they put out.
So I was going to go to.
For $4,000 is their baseline for next year. But up to $5,000 if Fed independence is undermined. If you get talk to me about Fed independence and what for you would be the trigger that says, okay, this is an undermined Federal Reserve, and then how that would change your advice to your wealth clients.
So we're looking at the developments regarding Governor Cook and whether she's replaced, by whom, and whether the Federal Reserve, the regional Federal Reserve governors, whether they are reappointed. If the hawkish ones are not reappointed, you would have a very, very dovish board, and therefore much lower interest rates than even the market expects at the moment. So the point about Fed credibility, Fed integrity is very, very important for the US dollar in particular, and that is where the gold scenario does come in.
And when it comes to the bond markets then, bringing it back to that, yield curve steepness, that trade has further to go?
We think it does. Again, going back to government finances, and markets are probably thinking ahead at inflation coming back into the system, probably from trade tariffs coming through, and that is pushing up yields.
I guess, a lot of the market action this week has been in the bond space, seems to have been settled for now. Do you still think there are risks in the horizon to higher yields? And does that in somehow change your equity market view? How are you thinking about fixed income?
So we do think there's a possibility of steeper yields, and therefore we focus on the part of the curve which is less than 5 years. And again, this idea of really strong conviction, so European AT1s, you think of steeper yield curve, that's good for the banking sector, and we think that AT1s will be very well supported.
Out of all the assets in the world, what do you think is the most underpriced right now, given your view?
Look, we have a very strong conviction about biotech. Biotech stocks, for us, both from a top-down and a bottom-up perspective, they're interesting. They benefit from lower interest rates and also from a more lenient Federal Trade Commission, which will allow more M&A. And of course, Big Pharma has a pipeline issue with $350 billion worth of sales, which are vulnerable to patent expiries. They have a lot of cash on the balance sheet, and they think often that biotech stocks are part of their pipeline. So we expect more M&A activity. And from a bottom-up perspective, we expect good news on select stocks in terms of clinical data, approval, or even higher estimates of what commercialization of products might bring up.
Interestingly, in your notes, switching from biotech back to the bond markets and what's happening with gilts, you seem to be rather unconcerned about the sell-off that we've seen in the gilt markets, and that's been corrected now by the end of this week, because you say this is a government that is taking deficits seriously and is one of the few to do so. What does that mean? Are you adding gilts then in that assessment?
So we're not, but we're mindful that there's very little headroom, right? The headroom that the Chancellor set herself was just under 10 billion pounds in order to meet her balanced budget by 2029-30. Before 2022, most chancellors had a headroom of 30 billion. So the Chancellor is very vulnerable to any changes in circumstances which are outside her control. So we're mindful of that. We know, however, that the 10-year gilt issue recently was very well supported. There was strong demand. So we have, I suppose it's a nuance. We don't want to be too pessimistic. We realize there's still demand, but we are mindful that the situation is quite precarious for government finances.
Frederic, nice to see you. Thank you very much indeed for stopping by to see us sell up September. As we start the month, looks like volatility could be on the way, but today, maybe a session of calm. Frederic Canny, Head of Investment Strategy for the British Isles and Asia at RBC Wealth Management. Course 6 looks a little bit like this. This is the picture that we are watching at the moment. A game of two halves. Tech actually is doing reasonably well. SML, Schneider, okay. Nestle bouncing back a little bit today after being badly beaten up earlier this week. Novo's a little soft. LVMH is a little soft. Rheinmetall is a little bit soft. But that kind of sums up the market at the moment. Basically, one side, it seems, is offsetting the other. What else are we watching? Let's find out with Chloe Mellon.
Good morning, Guy. Let's start with perhaps a surprising move for Sanofi today. The shares are down 9%, and that is despite Sanofi having an eczema drug that cleared a late-stage trial, which should have set it on course for a big win. But for some reason, the market is reacting quite negatively to what should have been quite positive news. Moving on to Heidelberg Materials over in Germany. Heidelberg makes cement and makes concrete. It's in that kind of building materials supplying space, and it was rated a new buy rating at Goldman. It is up 1% on the back of that. It's a stock that has benefited from the sentiment around infrastructure spending in Germany in particular. Moving on to another building materials stock, this time over in the UK, Grafton. Grafton this morning had really positive earnings that beat estimates. It also had a new buyback and said that performance in Ireland was particularly strong. So on the back of that, we have a positive share move with shares up 1.5% this morning. And finally, let's end on Getlink. Getlink operates in the road infrastructure space, and it was downgraded at JP Morgan, and so we can see the shares getting a little bit of a beating on the back of that. We're down 2% for Getlink.
Okay, Chloe Mellon from my equity team, thank you very much indeed. We'll stay on the stock story, some specific names jumping out, particularly in the travel and leisure space, with airlines falling, Guy.
Yeah, Jet2 is the epicenter of the action this morning. Its stock is down really quite sharply, talking about an EBIT very much at the bottom end of the range. You got an AGM statement update this morning, which is why I think it probably was off our radar this morning. But that stock is down pretty hard. They're sort of pointing as well to what they're going to do this winter. They're talking about near-term bookings as well. All of that raising a few concerns, it seems, at the moment. But as you can see, you've got airline stocks down really sharply. I was wondering why EasyJet was down by 4.5%. So EasyJet has a holiday model as well, so it's not the kind of the pure play kind of more airline story that Ryanair is. So Ryanair is down by 2.75. EasyJet though is down by 4.5, as is TUI, which are the kind of more closer comparisons with Jet2. But Jet2 is halted and down by 17.5%, Tom.
Okay, we'll keep across the story when it comes to the airlines and some of the sell-off that we are seeing in the session today and the catalyst for that. But we're going to go macro and go back to monetary policy after the break, because Bank of England Governor Andrew Bailey has played down the importance of a surge in long-dated yields. I'm going to tell you why. That is coming up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Welcome back. 17 minutes into the Thursday session, and as you can see, we've got a lot of activity out there. We don't at an index level. I'm joking, of course. We're up by 0.2% across most of the main markets this morning. There are a few areas of weakness. The CAC is down by 0.3%. Not entirely sure that's related to what we're seeing actually with French politics. We do, though, see a little bit of a bid back into equities, a little bit of stability back into the bond market. At the moment, it looks like US futures are broadly positive, but you've got ISM to get through, you've got claims to get through a little bit later on. There's a lot of labour market data coming today and tomorrow, so there's a lot to pay attention to. The story, though, I think is really interesting. There's a number of sort of different currents today, and BYD is one that really stands out to me today. And it hasn't had the biggest effect into Europe. I thought there might be a bigger effect of this kind of BYD story into Europe. That's not turning out to be the case, but the BYD story is interesting.
Possibly more of a domestic story, but we'll get Danny Lee shortly on that, because to your point, they've cut their targets, and significantly so in terms of sales. The stock is down about 3% so far in the session. So BYD shares down this morning after reportedly slashing its full-year sales target by almost 20% as intense competition in its home market of China eats into profits. According to Reuters, the world's biggest seller of electric vehicles, now plans to deliver 4.6 million units this year. That is down from its previous expectations of 5.5 million. Let's bring in Bloomberg's Asia transport reporter, Danny Lee. Danny, what is driving the decline for BYD then? And should there be concern amongst European automakers that still have skin in the game when it comes to the Chinese market?
Well, the reality is BYD is not going to sell as many cars as it hoped. Almost 1 million units is going to fall short on. And you know, when the market and when analysts have been looking over recent months at how BYD has been progressing, it has been increasingly concerned by the lack of growth in its delivery numbers and the ambition that it has, obviously, going global and particularly advancing in parts of Europe. So there has been a struggle in recent months. And so when you look at the stock decline this morning and into the afternoon, it's little surprise, really, that the shares are down only by 3%, because the consensus actually is for around 4.5 million deliveries this year for BYD. So it is a bit of a watershed moment for someone who's gone through so much breakneck growth in the EV sector overall. So yeah, I think it's a bit of a reset moment for BYD, who has been facing a lot of regulatory pressure around its aggressive discounting in order to stoke up sales. And so maybe it is a bit of a sigh of relief for competitors. And yeah, this is largely a domestic story, but this does feed into the international picture.
Danny, I'm seeing a few BYDs on the streets of London, but not that many. And I'm wondering kind of if we do see the domestic story in China slowing, if the demand isn't there, if the overcapacity story really is starting to have an effect, whether or not there is the alternative of shipping some of these cars or this capacity overseas. But that looks like it's a struggle at the moment.
Yeah, BYD is selling fewer cars overall internationally, but it is doing a lot better than, say, like last year. So it is increasing its momentum, and so with its factories and being built from places like Brazil to Hungary, it is going to be able to have more of a presence at a different kind of cost base than rather than just importing from China. And so when you look at its presence right now, maybe if that story domestically is weak, the fact that it can then double down on its international push. So when you look at some of the European auto majors who may think this is a bit of a good news story for them, maybe not, because maybe BYD will be able to focus on the higher margin sales internationally, where it has been able to be more effective because of the kind of products it does offer. So it's a bit of a mixed bag here, really, and maybe for the likes of Volkswagen, Mercedes and whatnot, it's not necessarily a good thing that if BYD is failing abroad in China, it could very much double down abroad.
All right, thanks for joining us. That was Bloomberg's Asia transport reporter Danny Lee on the latest out of BYD. I thought it was interesting there. He mentioned that he was surprised the stock is only down 3%, because if you combine that with the fact that Chinese indices were decently in the red overnight due to these regulatory concerns wanting to crack down on the stock rally, then you can see that BYD should really be down substantially more. You have CSI 300 down over 1% and HS Tech as well.
And maybe there's a read across later for Tesla as well, because Tesla's performance in China is crucial to that automaker's longer term plans. They're suffering, of course, in Europe. Sales have been falling in the Chinese market for Tesla. You see the number of registrations they got in India, which is a new market for them, which was pretty pathetic in terms of the numbers that came through. So it's a reminder of the competitive threat. It's a reminder of the fact that the Chinese economy, the foundations are still not there in terms of giving that consumer that kind of optimism to pay more for their vehicles.
It's a classic kind of boom and bust story, isn't it, though? The Chinese have driven the Chinese automakers to deliver this kind of capacity and now don't have the end market ultimately to meet it. And you wonder whether or not this is going to be represented in the AI story as well, where there's kind of notes of caution just kind of coming out of the Chinese government. Not everybody needs to do this. We need to be focused. This shouldn't just be a free-for-all. And I'm wondering whether that is going to be a story that is different, therefore, to what we see in the auto narrative.
Does BYD attract the same retail volumes that Tesla does in the U.S.? That's what I'm thinking.
Well, they've got no market. They've essentially got no market in BYD have no market in the U.S. because of the 100% plus tariffs. But Europe is central to their strategy. And to your point, historically, we've seen this time and time again that there is a pile-in effect in China across certain industries that are suddenly hot. I mean, we saw that with bike sharing, where we had about 100 different companies, and then they effectively all were washed out of the system. So it happens. It's happening with the auto space. There will be some winners but there are going to be a lot of losses along the way.
Let's talk about what's happening in the gilt market. Gilts are now open. We've obviously seen a huge ride this week in terms of the ups and the downs, in terms of what we've seen in the bond market. A bit more stability may be returning. Bank of England Governor yesterday, Andrew Bailey, downplaying the importance of a surge in long-dated gilts, basically saying he wouldn't exaggerate the significance of 30-year bond yields that we are seeing. And in some ways, you could argue that actually this doesn't have much of an impact. This is what he had to say.
Although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps.
Bank of England Governor there talking at the end about kind of what he sees in terms of the interest rate trajectory from here. Kit Rees, editor of Bloomberg Markets Today, is here. So let's kind of sum up what Andrew Bailey had to say yesterday, downplaying the 30-year, you can understand why, and also kind of downplaying the possibility of an interest rate cut as well.
Yes, so overall the tone has been interpreted as being more cautious, and this is probably confirming the paring back we've seen in bets about further rate cuts going forward in the year. So we had the August rate cut decision. We had this historic deadlock amongst the Monetary Policy Committee members. Yeah. So this was really, we wanted to kind of hear more comments about their thinking, about why certain members voted that way. So it was really interesting how there's a big focus on inflation, especially from some of the more hawkish members, such as Deputy Governor Claire Lombardelli, and also from Megan Green. But again, the Bank of England's going to have to weigh this up with worries over growth and also the labour market, which first showed signs of softening, then showed signs of stabilising. There's been issues with data quality. So overall, it's a little bit of a confusing picture. So no wonder there's a bit of caution, but it seems to chime with market thinking now.
Well, in terms of confusion, why would the government plan such a late autumn budget? The date is now November 26. Why are they delaying it?
It's a great question. So it's a very mixed picture on the growth front, on the economic front. So perhaps they just want to get more of a certain view on what's going on. We've had inflation, which is proving very, very persistent, but then we've had this weakening of the labour market. So it'll be great to kind of see these issues reconciled. We've also got many risk events. We've got Bank of England meetings, inflation data coming up, and so it'll be great to see these kind of risk events being played over. Plus, now that government borrowing costs are a lot higher, there's this kind of issue to contend with. So there's a lot going on, and it'll be interesting to see how it all plays out.
And this is a government, this is a cabinet as well that's contending with the challenge and arguably the distraction, the Deputy Prime Minister, and the focus on Angela Rayner and some unpaid taxes. How much of a political risk is that for the government?
Well, markets don't like uncertainty, so if this escalates or develops in any way, that might be seen playing out in the market. But for now, we haven't really seen a big reaction. Sterling was off a little bit, but yields seem to have been back to where they were pretty much. And trading over the summer was a bit of a lull, FTSE 100 drifting to record highs, so that kind of looks okay. But if we see any further development, we might see more reaction. But for now, it's not a big deal, I'd say.
Great to see you, Kit. Thanks for stopping by to update us. Really appreciate it. Kit Rees, Bloomberg Markets Today editor. Thank you very much indeed. Coming up, as President Trump asked the US Supreme Court to uphold his global tariffs, we're going to talk to Roger Fisk, Senior Advisor at Boway Communications. That's next. This is Bloomberg.
With the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number two, because you could be number two in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, The good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
This is the opening trade. We are 30 minutes into today's session. So Guy flagged for us earlier the correlation between the stabilizing bond market in the session yesterday and the upside that came through, particularly towards the end of the trade stateside in equities. Those dynamics continue in the session today. Bond markets are stable. You're seeing modest gains of 0.1% across the benchmark here in Europe, building on the upside that we saw yesterday of around 0.6. In Germany, the DAX gaining 33 points. There's a bit of weakness over in France. The CAC 40 is down 0.4%. But here in the UK, despite the challenge around some of the travel and leisure and airline names, currently seeing gains of 0.1% on the FTSE 100. Guy.
It's interesting. I think actually the market now feels like it's definitely holding its breath, waiting for the payroll number. We've got a lot of data coming out of the US a little later on today as well. Don't ignore that. But at the moment, this is a fairly evenly balanced market, highs and lows. You got, well, actually, maybe that's not true. Nearly 400 up, 200 down. In terms of the volume, though, we are very light right now in terms of the internals we're watching at the moment. So maybe the market is just now waiting for maybe the next catalyst. That could be payrolls. It could be the CPI data that comes out next week. It could be today's ISM. Lots of things going on out of the States that we need to be paying attention to. Let's talk about some of the 52-week highs and lows. I've got a 52-week high today. I just want to kind of emphasize. UCB, this is a biotech company, focuses on epilepsy, big momentum trade over the last few weeks. And as you can see, the stock has been on a tear really since the spring of this year. And that momentum continues today. We're up by 26% on the year. And that stock hitting a 52-week high today. So that's what the stock story looks like. Here's Val with all the other news you need to know.
Here's what else you need to know this morning. The Portuguese government has declared a national day of mourning after 15 people died in a tram derailment. Local media say the cable that supports the tram car snapped, sending it crashing into a building. 18 other people were injured in the incident. The tram is often used by tourists for short trips in the streets of central Lisbon, with some 3 million journeys made each year. President Trump's campaign to reshape the Federal Reserve gains ground today with an accelerated Senate confirmation hearing on his nomination of a close advisor to be the governor of the central bank. The Senate Banking Committee's examination of Stephen Miron's appointment will provide a look at how a prominent Republican senators will balance their support for an independent central bank against loyalty to their party leader. Bloomberg will have live coverage of the hearing from 3 p.m. London time. And finally, tech industry leaders are expected to attend an artificial intelligence event hosted by First Lady Melania Trump later today, then join President Trump for an evening reception in the newly renovated Rose Garden. Meta's Mark Zuckerberg, Apple's Tim Cook, and Microsoft's Satya Nadella are among the invitees. Guy?
Let's carry on the conversation around what is happening in Washington. President Trump is asking the Supreme Court now to uphold his global tariffs in a fast-track case that could reshape trade policy, or kind of keep it as it is, to be honest, right now. It follows a federal appeals court decision a few days back that indicated that the president can't impose wide-scale import taxes by invoking a 1977 law designed to address national emergencies. Let's talk about all this and all the other things that seem to be going on in D.C. right now. The list is long. Roger Fisk, Senior Advisor at Bowie Communications and a former aide to President Obama, joining us around the table. Good morning.
Good morning, all. Thank you so much for having me.
It's an absolute pleasure to see you. Let's talk a little bit about where we are with tariff policy right now. As the rest of the world watches what is happening in D.C., there is confusion about whether or not the legal cases against some of the tariffs will be upheld. If you are a European, an Asian, a global representative of a government trying to negotiate with the United States, what do you do with this? What do you think is going to happen next?
Sure, and thank you so much for having me. Before you even get to the confusion created by the case that's gone from the appeals court now to the Supreme Court, there's the confusion of how the administration has even talked about and implemented these tariffs.
Yep.
I believe at this point, most of the tariffs writ large have changed somewhere between 55 and 60 times in the sense that they're delayed, they're doubled, they're tripled. It's Monday and it's 10%, it's Tuesday and it's 25%, it's Wednesday and it's punted for 90 days. So we come into that with that uncertainty. To get into the legal dynamic regarding the case that's going to go to the Supreme Court is traditionally very reluctant to empower the executive branch beyond the actual language of the law.
Court?
So what I'm really looking at there is Amy Coney Barrett, because I think she's going to become the swing vote, almost the David Souter of this generation.
Yep.
And if you look at how she's sided with the liberal end of the court a couple times, I think where she falls is really going to drive how they decide this.
Once this court case is through, do you expect stability? Should we be expecting more stability? Or do you think the chaos that we're seeing, as you say, continues? Is this just the narrative that we're going to have to live with throughout this administration?
I think once you take the India example for just a moment, which is, the image of Modi and Xi and Putin from just 48 hours ago is really the result of the Prime Minister gently contradicting President Trump's version of his involvement in the India-Pakistan dispute. All of a sudden, once that entered the news cycle, the president elevated the tariffs by another 25% because of being somewhat called out on the global stage. And my point is to say that this is largely capricious and random and personality-driven. So one of the things that I think we all just have to kind of accept and get our arms around is that this administration is not a policy vehicle. There's not a framework or a worldview. It's much more driven by if the president just had a great call with President Sheinbaum, then things are great with Mexico. And if he has an issue with Mark Carney, then all of a sudden it's worse with Canada. It's all circumstantial, in and of the moment, personality-driven, as opposed to a more kind of sober policy framework that you would see in a traditional administration.
Roger, with that context and the legal challenges, as you look into 2026, what does the picture look like when it comes to the tariff regime of the Trump administration?
Yeah, I mean, what you're just seeing now is some of the large American businesses, especially the retailers in kind of the family goods space, cradles, strollers, groceries, starting to say that they are no longer going to absorb the cost of the tariffs, which now, from what I saw this morning, are $210 billion that have been accumulated from American importers, American companies, and ultimately American consumers. So the question is when does that start to manifest in costs that families talk about around the kitchen table? And then the second question is to what extent that Democrats can build and deliver and have resonate a cohesive, targeted conversation with the American people around the economics of it and what they intend to do to counter that and bring some of this stability back, to connect your two questions.
So that brings us directly to the domestic political challenges or costs of this. If there are costs for the Trump administration leading up to the midterms next year, what is happening right now? How is it changing the domestic politics of the US right now? Is it doing anything to erode President Trump's popularity, or is he winning on the argument that this is bringing in revenues?
It's bringing in revenues, but it's bringing in revenues from American companies and ultimately American consumers. So the idea of giving a rebate is kind of the dog biting its tail in a lot of ways. I think what you're going to see right now is, again, to what extent the cost of this, and there's larger costs around the tariff issue. For example, just this morning, I saw news around the soybean farmers in the Midwest of the United States, Nebraska and Oklahoma, who normally would have a full ledger of orders from China that would be 10 to 15% of their product every year, and there are 0 orders from China.
Does that put the wind in the sails of the Democrats in the midterms?
It puts wind, and it's the Democrats' job to get it in their sails.
That's a good analogy. I do want to take this tariff conversation a bit more long term. Let's say the Republicans lose the next presidential election and we get a Democrat in the seat. Will he repeal the tariffs? Because Biden let those China tariffs that Trump 1.0 put in. They're a really hard thing to repeal, especially once you start gaining revenue from them. How do you think the next administration, if there is a change of party, will deal with it?
Well, again, and I appreciate the question. The premise of calling it revenue is really a circular dollar that goes from Americans into this tariff pot. I can't imagine that a Democratic president would maintain this. One of the things that is so surprising to me, because the president bases all of this on this idea of the trade deficit, is that if you're the largest economy in the world, it's going to be very difficult to find a country somewhere in the world that you're not buying more from than they are from you, right? So in that sense, I think any Democrat or even another Republican would want to come in and actually calm this down and put it in a larger policy framework for no other reason than just one example, which is this. If we're going to talk about repatriation of manufacturing jobs, then part of that has to be about skills and bringing coding skills and robotics and AI skills to the American workforce. There's 0 conversation about that from this administration, which gets to my earlier point that it's not a full, robust policy conversation, because if it was really about repatriating jobs, there'd be a whole conversation around skills and education to the next generation of the American worker, and that's not happening.
Well, what do you think this policy is really about then?
I think that the president thinks in very blunt terms, and in a lot of the large issues, he gravitates towards very blunt, simple solutions. So if you talk about immigration, it's one word and it's wall. And if you talk about trade, it's one word and it's tariffs. And there's some comfort in that simplicity, but as we all know, just from listening to your programs as often as I do, simplicity is an illusion in any one of these matters. For example, with the trade deals, there is, to just announce a trade deal with a country is not really a trade deal in and of itself, because what really creates the structure and the traction for a trade deal to really mean something is very detailed language around things like transparency, verification, remedy, enforcement, all of those things. Most trade deals take 1 or 2 or even 3 years to actually turn into a 2,000-page document. And that's also another example of where we're just not seeing that policy component from this administration, leaving it much more personality-driven.
Well, we certainly see the Europeans and the British as well trying to nail the jelly to the wall on some of the trade deals that they've struck with Washington. Fantastic analysis on what is happening in terms of the thinking within Washington, particularly around the trade story. Roger Fisk, Senior Advisor at Burway Communications, former advisor to President Barack Obama.
Okay, let's turn attention to what is happening in Portugal. We will get you an update next as to what has happened overnight. The Portuguese government declaring a national emergency. 15 people have died in a funicular derailment in Lisbon. We'll have the details for you next. This is Bloomberg.
think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Thursday, the 4th of September, 45 minutes past the hour. The Portuguese government has declared a national day of mourning after 15 people died in a tram funicular derailment in Lisbon. Local media say the cable that supports the tramcar snapped, sending it crashing into a building. Let's get an update as to what we know and what happens next. Enrique Almeida is in Lisbon for us. What do we know about what happened?
Well, good morning. So far what we know is that the cable that supports the tram snapped as the tram was coming down one of Lisbon's hills, and it crashed into a building further down that hill. 15 people have died. Initial reports said 3 people had died, and then we got an update later in the evening saying that 15 people have died, and now 23 people are injured, some in serious conditions. So we expect to get more updates about who the victims from this crash are, but most likely there will be tourists that were visiting Lisbon at the end of the summer season here in Lisbon.
Enrique, what is the government saying about this tragedy at this point?
Well, the government has offered its condolences, of course. It declared a day of mourning, and it said it will try to answer all the questions that have been raised about the possible infrastructure problems that affected this accident. The government has also suspended all the other trams that are running across Lisbon, and an inquiry is currently taking place to figure out what went wrong here.
Okay, Bloomberg's Enrique Almeida on the latest out of Lisbon. Enrique, thank you. Switching focus now, European leaders are expressing concern that Russia will mount a new offensive on Ukraine as they discuss security guarantees for the country with President Volodymyr Zelensky. This as Russian President Vladimir Putin says Zelensky should meet him in Moscow. Our Europe correspondent Oliver Crook has the latest. Ollie, talk us through what to expect then from the meeting today. Is anything that's going to come out today actually going to move the needle for Ukraine?
Well, that will really all depend on Donald Trump and whether or not they can convince to get Donald Trump a bit more on the side of the Europeans, which of course has been the great effort for the last few months, is to try to get Donald Trump to see things as the Europeans do. For this meeting, the Coalition of the Willing, just a reminder, is the broad European format. It's chaired by Keir Starmer and Emmanuel Macron in Paris. And here they really have two ambitions. One is to talk to Donald Trump and to talk about possibly putting more pressure on the Russians to try to get them to the negotiating table, maybe getting on board further with with those secondary sanctions. We've already got sort of phase one of that is what Trump suggested is what we're looking at right now with those 50% tariffs on India, and that could ramp up. But the second part of this is, of course, this question of security guarantees and the coalition of the willing. What we don't have the answer to is the question of what are they willing to do? What does this coalition look like? What does a reassurance force look like in Ukraine the day after peace? That is going to be some of the details that they're continuing to work out. And we should say that that is not a very sort of easy question to answer. We should also say that it's an irrelevant question until there is peace in Ukraine. And judging from the last couple of weeks where we've seen massive drone attacks, missile attacks by the Russians, now reports that you have actually more Russian troops massing on the part of the Donbass that they don't collect, 100,000 troops that are apparently now aligning to the border there, according to Zelensky. Will this eventually convince Trump that Putin is actually just playing for time, as the Europeans said from the beginning, to say nothing of the last 72 hours, where we've seen basically, though Russia's position on the war hasn't changed, Russia's position in the world certainly has. Whether he's holding hands with Modi, he's sort of embracing with Kim Jong-un. This is a different calculus for Vladimir Putin, and that is all for Donald Trump to interpret and trying to figure out how to respond to that.
Ollie, are there questions in France about whether or not Emmanuel Macron should be focusing on this or focusing on what is happening domestically and the problems that the government in France currently faces?
Yeah, I think it's a completely valid question, Guy, and it's one that I don't think anyone's asking, to a great deal at the moment because they're so distracted by the political drama that is going on within France. But let me just sort of set the scene for you here. This is a meeting that is chaired by Keir Starmer and Emmanuel Macron. Are these leaders that are in particularly strong positions in their nations? I would say certainly not. Certainly not Emmanuel Macron. He's about to have his government collapse yet again, probably on Monday. And the question is, at what point is France in a position to make these guarantees, particularly if, and again, this is going a little bit further down the line, you have to have other snap election. The biggest party in France is the Rassemblement National, Le Pen's party, and they are very sort of skeptical of Ukrainian support. Are they going to get on board with an idea of putting French troops, potentially as peacekeeping troops within Ukraine? These are questions that I don't think are self-evident, and this is something that is still sort of moving forward. I think the UK support, no matter where you are on the political spectrum, is a little bit more secure than it is in France. But again, there's a big question about what the future of French politics looks like and whether or not Emmanuel Macron is really in a position to be making these very bold guarantees.
Ollie, I want to focus in on that last point there, the fact that we might have the French government falling apart next Monday on this no-confidence vote. How long until we could get a French budget passed that could have some of these promises they've made to Ukraine in it?
I think the problem is that no one can answer that question. I mean, you look at the polling, even if they did call another sort of legislative election after the collapse of the government, which will be presumably happen next week, the polls are basically unchanged. You have this story that we've seen all over Europe, whether it's in the Netherlands, whether it's in Germany, whether it's in so many countries within Europe, total political fragmentation. And right now, no matter who you talk to, you listen to French radio. I was in France last week, you speak to people, no one sees how this can get resolved. Will Macron try to tack to the left? That won't even be enough necessarily to get him a majority to be able to do what he wants to do. So there are just these sort of unanswerable questions at a moment when, Val, you're looking at the budget deficits within France and the amount of debt that they're collecting. This is really going to come to a head at a certain point, but at the moment there is really no through path. So we're going to have to see if they can pull anything out over the next couple of days. I think it is all but assured that the government was going to fall. I mean, you watch the interviews that have been on French media over the last couple of days with the Prime Minister, they all begin with, so, how do you feel about your last few days in office? He tries to put on a brave face, but it's not really that convincing.
Yeah, interesting stuff. Ollie, thank you very much indeed. Ollie's going to have a busy week next week. We'll certainly be covering this as we get into the beginning of next week, Monday. Obviously, a key date for your diary. Talking about key dates for your diary, what are we watching for the rest of the day?
9:50 a.m. Talking of French politics, an 11 billion euro French bond auction. French bonds right now being well behaved. In fact, yields are down about 1 basis point. So we'll watch that bond auction, see how well received or not it is in about an hour's time. At 1:15 p.m. UK time, we're going to get US ADP employment data. So building out the picture from JOLTS that came in, of course, job openings shrinking more than expected yesterday. At 1:30 p.m. UK time, US additional jobless claims staying on the labour market of the US. And at 3 p.m, it's the US ISM Services Index. That's dropping at 3 p.m. And later, Stephen Myron, Senate confirmation hearing, of course. No senators from the Republican side yet have come out to say they're going to attempt to derail this. And, of course, they're trying to get him in place before that September the 17th decision from the Fed, where they are now expected by the markets to cut.
Yeah, that's right. And he has also released a statement ahead of the hearing, really backing Fed independence. So it does seem like he's going to toe the line that he thinks the Senate is going to want to hear. But elsewhere, gilts, bunds, and OATs are all trading higher across the curve as calm returns to the European bond market. Here's what BTV guests have had to say on the extraordinary price action in the bond market this week.
We know that the prevailing narratives don't make sense, right? This is not about public sector debt levels. This is about investor behavior and investor psychology.
Well, that is part of the narrative clearly here in the UK.
Yeah.
I don't think it's contagion. I think it is incidentally really in global bond markets sort of several idiosyncratic factors that are meeting at the same time.
The situation in the UK is quite dangerous at the moment because of the return of the bond vigilantes.
Yeah, I try to not predict the triggers, right? I try to look at, what is the signal rather than the noise. And the signal is quite clear that there is still, at these levels, no appetite for the long end.
I would have a reasonably high degree of confidence if you could fast forward 3 or 6 months. You'll probably make a lot of money in these bond markets.
I don't think people are massively going to flock into US Treasuries now, because that either would be really only happening if we did see really some significant deterioration in the data, that's number one, or if we saw some proper risk-off.
We were told for most of the last 10 years that these were safety assets. What's really going on here is people were buying these hand over fist when yields were 0, when yields were 1. And they are sitting on huge capital losses. There's a huge risk premium because we're pricing the past.
A lot of hot takes on the moves in the bond markets this week from guests sitting around the table. Is it over for now? It might be all down to the data. We get more labor market today. It was the weak JOLTS data that really added the calm into the Treasury market yesterday. Today we have ADP, jobless claims, ISM services, and tomorrow, payrolls.
Are we going to watch? What are we going to? I wonder where the surprise comes from. Does it come? Is prices paid in the ISM a number you want to look at? Are we pretty much locked in on what we think the labour market is doing? Does the surprise now come from inflation? Where does the surprise come? The market feels convinced that 25 basis points is locked in for September. Kind of what? Is there anything that knocks us off course on that? Pooja Kumar was here talking about the fact that it's certain, it is definitive, that is going to happen. Is it?
And Pooja Kumar is making the case for 2 more cuts beyond September. Yeah. And that brings us back to the inflation story, because if you look at what's happening coming through in the Fed Beige Book, and if you get that price pressure coming through and the ASM data later today, and the fact that those inventories have been drawn down, basically if you get a more inflationary environment in the US, and there are some indications that that will happen towards the end of this year, how can you justify going beyond September? Are we September and done? And then what is the bond market reaction? Where we speak to our guests, the consensus trade seems to be buy the front end, steer clear of the long end. Does that still be the trade in that environment?
Well, it might be down to what we hear from these potential Fed chair candidates. We know, reported from the Wall Street Journal, those interviews start with Scott Bessent on Friday. Perhaps they make a lot of noise, pushing the Trump agenda, saying it's deflationary, saying that any inflationary bump is just a speed bump in the road, and we should continue to cut. Exactly.
Is the market going to look at that and go, no, we'll want to do at the front end, but the back end, that's where the fear starts to come in. That's it for the opening trade. Tomorrow's payroll day. We're done for the day. The Pulse is up next. Hope you enjoyed the show. We'll see you tomorrow. This week's not done just yet. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Rate cut optimism. Weaker than expected US jobs data cements bets that the Fed will ease policy later this month. Bonds trade higher as calm returns to Europe. Elsewhere, China looks to cool market speculation as concerns mount about a rapid $1.2 trillion rally. Plus, Sanofi slumps after a new eczema drug disappoints in a late-stage trial, sending shares down as much as 9%. Let's check in on these markets, and it's a calmer start to today's session. We had that bad economic data being good news for these markets, and it continues now. A muted start, let's say, in Europe. Futures pointing higher stateside. That 30-year Treasury yield edging away from the 5% level, and the pound at 134 after that hawkish commentary from the Bank of England governor. Flip over and we can check in on how markets are faring across the European continent. We've had a bit of outperformance, especially for the domestic stocks here in the UK as well as in Germany, but underperformance when it comes to France. Let's get started. The pulse starts now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Lizzie Verdon in London, in for Francine Lacqua. We have US equity futures edging higher after that weak US jobs openings data reinforced bets on a Fed cut later this month. We've been hearing from the Fed's Alberto Mussolem signaling that he thinks current policy is in a good place.
The current modestly restrictive setting of the policy rate is consistent with today's full employment labor market and core inflation nearly 1 percentage point above the Fed's 2% target. Looking ahead, I expect the labor market to gradually cool and remain near full employment, with risks tilted to the downside.
Well, let's talk more about those hopes for Fed easing and markets. Joining me now is Henrietta Pachmon, Senior Portfolio Manager over at Allspring Global Investors. Welcome back, Henrietta.
Good morning.
We've got this reprieve for treasuries, but how fragile is it?
Well, I think what we're seeing now is a bit of a body of information on the labor market in the US coming in weaker. So I think that is helping put a lid on rates, that's starting to be reflected in the market. That being said, we've got two big numbers coming up, so it'll be interesting to see how that plays out.
Yeah, we do indeed. So for the payrolls number, is there any sort of print that could put 50 basis points on the table?
So I think increasingly market participants are looking at a number of metrics, not just the jobs number that is coming up tomorrow. So they will take it into account. I think for it to sort of move the expectations that are priced into the market, it needs to be a big miss or gain compared to what the expectations are at the moment.
But is a quarter point cut so well telegraphed at this point that no data point could take it off the table?
I think it's going to be tricky at this stage. Again, the data point that is coming in next week on the inflation side is going to be interesting to watch. But again, I think it needs to be a big miss really to get us off track for that 25 basis points.
So what sort of duration do you like along the curve then?
So at the moment, our preferred area of the curve is probably the intermediate space. That's an area where you can benefit from the rate cuts as and when they come, but you don't necessarily have quite the volatility and the dynamics that you've got on the long end of the curve. If you look at performance year to date, that has played out to our favour, so that remains for the moment our preferred location in the curve.
Okay, and we've got Stephen Myron's nomination hearing happening later on in Washington. I wonder how much of the Fed pricing accounts for the political pressure that we've seen on the Fed.
So I think, unfortunately, the political pressure is there. At this point, given the numbers that we're seeing in the neighbour market, they've got to get out of jail card, as it were, because they can look at responding to market conditions. So I think it is playing in the long end, and it is sort of creating volatility at this point. But I think it's probably a stretch to say that the independence is an issue at this point.
And if we can bring it to the UK, because we had Bank of England Governor Andrew Bailey warning about Fed independence as well yesterday. We've had these wild moves at the long end of the gilt curve as well. We were talking to Eric Lonergan over at Calibrate, and he says it's more about investor psychology than actual fiscal concerns. What do you make of that?
Well, the UK is in a completely different situation to the US. There we're looking at sort of structural issues, but you are looking at a government that is looking to address the deficit. And then there's a bit more of a supply issue that is hitting the UK. So I do think there is an element of confidence and market behaviour when you start looking at the UK. And I think maybe a bit of memory of what happened a few years ago.
PTSD of 2022.
PTSD of 2022, though I think the market conditions are completely different because you had some embedded leverage in the government market that is no longer there in the same way in the UK market.
But you have Bailey saying ignore what's happening at the long end of the gilt curve, basically. But do you actually need to have fiscal and monetary policy working together a bit more here?
I do think that they need to work together, obviously, because of the sort of twin deficits in the case of the UK. But I think if you look at the UK, they need to balance confidence and getting the growth going and getting sort of market spirits up, as well as dealing with the deficit. So it's tricky, more structural, longer-term issue that they need to deal with.
Yeah, it's hard to get growth going and get out of the doom loop if you raise taxes again.
Correct.
But just back to the Bank of England, what should they be doing then? If they should be working more closely with fiscal policy, does that mean ending active gilt sales? What's the role here?
To be fair, they are very sensitive to the technicals in the gilt market, and we've seen them time and time again intervene if they feel that the market is getting out of hand. And I think that kind of behaviour is going to continue. But then, from a rate setting perspective, the UK is still in a situation where inflation is still quite high, so they have to bear that in mind in their views going forward.
I mean, do you write off rate cuts from the BOE for the rest of the year? Now we've heard from the MPs.
I think it's going to be tricky, and if you look at what's priced in at the moment, there's not a lot priced in to any of the European curves, actually, at this point.
And just finally, I mentioned this warning from Andrew Bailey about Fed independence, attacks on it from President Trump. What actually is the consequence for central banks and for markets this side of the Atlantic?
The Treasury market is a big one.
Yeah.
A lot of markets in the world take their cue from it, not just in Europe, but globally. So it is a key market. On the independence piece, it is sort of harder than is maybe at first blush. It is a committee. A lot has to happen for that independence to be really effectively changed.
Yeah, I just wonder how much of the premium is accounted for by that and how much the fiscal concerns. But Henrietta, really good to talk to you. Henrietta Packmont, Senior Portfolio Manager at Allspring Global Investors. Now, elsewhere in these markets, we've got Chinese stocks slumping today as regulators in Beijing weigh measures to cool stock market speculation as their concerns mount about a rapid $1.2 trillion rally. What a problem to have. Let's bring in Bloomberg's Ros Matheson for more. Ros, is the mere threat of speculation curves enough to control the froth? Looks like it today.
Well, we are seeing an immediate market reaction today, but this is a market that was lagging for a long time and then suddenly in August sprung to life and is looking quite a bit frothy. I mean, it's interesting that authorities seemingly were happy to let that run over the past week or so because Xi Jinping had some very big events going on in China, hosting a lot of leaders from around the world. And we know that the Chinese do like to turn on a good show. And that's not just about the leaders being there and the military kit that was on display, but the market's looking positive. And so they may have been quite happy to have that continue through that period. I mean, they like to make sure that the pollution's not too bad in Beijing. Markets are looking positive in those moments. But there is quite clearly from our own reporting a sense of concern about this. And so what they want to do is just turn down some of the speculation. Perhaps, they loosen some of the curbs on short selling, for example, but they don't want a massive collapse in the market. They've been there before where it's gone very up and then very, very down very fast. And clearly, from our own reporting, what we're hearing is that what they want to do is just manage the market a little bit more carefully, perhaps have it continue on a positive trend, but on a slower burn than that, because the earnings, trajectory from companies doesn't really bear out necessarily where these stocks are. So a concern about that disconnect. And certainly the messaging is that they don't want the market to turn rapidly lower. What they want to do, perhaps, is just slow down some of that froth a little bit.
And if we could turn ours back to Washington, we've got Stephen Myron's Senate nomination hearing for the Fed's Board of Governors this afternoon. I'm sure he's going to pay an awful lot of lip service to Fed independence, but do you reckon it'll be seen as hot air?
Well, we do know ahead of time what he's going to say, and he's actually been saying it in recent weeks when he's having his conversations with different officials in Washington, which is, yes, I fully respect the Fed's independence. He's been saying that line now for some days, if not weeks, but the optics of the hearing are going to be very interesting because it is against that backdrop of Donald Trump trying to reshape the Fed more broadly. There's quite a lot of anger amongst Democrats on this banking committee about what's happening with Lisa Cook and Donald Trump's moves to fire her. But the question is, do the Republicans do or say anything? It doesn't seem any of them are really inclined to raise the hackles of Trump by trying to block this nomination. Do they show any concerns in their comments in the minute? The Democrats don't really have enough to kind of slow this down. So it does seem, regardless of whether he's saying this now because he's trying to get over the line or whether he really believes it, it's possible he'll be confirmed before that next Fed meeting in a couple of weeks where rate cut is very much on the table either way, but clearly he is also someone who will be attuned to Donald Trump's thinking where rates are. But for now, he's saying, to colleagues and no doubt at this hearing today that he's a true believer in Fed independence.
All right, well, we'll have full coverage of that hearing right here on Bloomberg TV. It's about 3 p.m. London time. At Bloomberg's Ros Matheson, for now, we thank you so much. Now, I want to get back to China because we have some breaking lines on DeepSeek, the AI race hotting up. DeepSeek saying that it's targeting the release of its AI agent by the end of this year. Of course, earlier on today, we've had the news that Apple is eyeing spring to launch its new web search tool for Siri, again, to rival OpenAI. This adds another element to the mix. So they're building this AI model. It's designed to carry out multi-step actions for you with not much direction from the user. This, according to people familiar with the matter, it is a Bloomberg scoop, and it's also meant to learn and improve on its prior actions, they have said. Of course, we know that DeepSeek upended the global tech industry back in January with the release of R1. They're pushing for this new software to come out in the final quarter of this year. So potentially getting ahead of the game when Apple comes out with its web search tool in the spring. But let's get back to the geopolitics now. European leaders expressing concern that Russia will mount a new offensive on Ukraine as they discuss security guarantees for the country with President Volodymyr Zelensky. This as Russian President Vladimir Putin has said that Zelensky should meet him in Moscow. Well, we can go now to our Europe correspondent, Oliver Crook. He's got the latest for us. Ollie, in this meeting of the coalition of the willing, how practically willing will they be to back Ukraine when we've got a ceasefire looking more and more distant?
Yeah, well, that's been the big question from the beginning. I'd say there's two real parts to this meeting. The first is to define what the willingness of the coalition of the willing is. This is something that we've been discussing for a number of weeks. We've been talking for a very long time, particularly with the Trump enthusiasm for getting a ceasefire and an end to this war, what the day after looks like. And these are conversations about the day after, what the so-called reassurance force in Ukraine could look like. This is something that could be spearheaded by Western troops that would be in Ukraine, to monitor, potentially also to keep peace. But again, these things are really sort of ill-defined in terms of what the willingness of these countries are to commit troops to this, what their exact function will be. So that will be a sort of large part of the conversation. The other key part of the conversation, Lizzie, though, is a question about peacekeeping forces after peace is completely irrelevant until there is peace, or there is a sort of indication that peace is possible. And at the moment, that is not the indication that we're getting from Vladimir Putin right now, which is why it's so crucial for these European leaders to speak to Donald Trump when they are all assembled, and they intend to speak to him a little bit later in this afternoon to try to get an idea of where his sort of thinking is with Vladimir Putin and try to appraise where he stands with Putin and where he thinks that Putin's intentions are. What they are hoping to have is from Donald Trump this idea that the Europeans have been convinced by for a very long time since the beginning, that basically Putin is just playing for time. He's not taking this any seriously. We've seen, over the last few weeks, huge amounts of missile strikes and drones. Does that sound like somebody that wants peace? In addition to the fact that we're hearing from Zelensky over the last couple of days that there are about 100,000 more Russian troops massing on the sort of edge of the part of the Donbass that Russia does not yet collect. Again, are these all efforts that Donald Trump thinks Vladimir Putin has any indication that he is willing to enter into any serious negotiations around peace? That is going to be for Donald Trump to appraise, and it's something we know Donald Trump is thinking about. We've heard from him over the last 24 hours. He says that he'll know whether or not he'll be happy with Putin in the next couple of weeks, depending on what Putin does. We should say, Lizzie, just as a final point, the broader context for this for Trump, and you can tell there is a little bit of anxiety mounting around this. The last 72 hours for geopolitics has been absolutely spectacular. That military parade that we saw in China, we see Putin hugging, embracing Kim Jong-un, we see him holding hands with Modi. These are all things that are go into the calculus for Donald Trump, and the Europeans are hoping that it's a calculus that will end ultimately, finally, in their favor.
Well, we're looking at the steps of the Elysee there. I wonder how much hand-holding Emmanuel Macron will be doing with those other European leaders in Paris. We await their arrival ahead of the start of that meeting at 9:30 a.m. Oliver Crook, we thank you so much for setting us up for that meeting. Now, to some other news, sad news out of Europe. The Portuguese government has declared a national day of mourning after 15 people died in a tram derailment. Local media say that the cable that supported the tram car snapped, sending it crashing into a building. At least 23 other people were injured in the incident, and the tram is a popular ride for tourists. It was classified as a national monument more than 2 decades ago. Well, coming up on the programme, as Monte Paschi reaches the minimum shareholder level required to buy competitor Mediobanca, Italian banking M&A is back on the table. And we're going to discuss the sector with Jackie Ineka with Spring Investments. That's next. This is Bloomberg.
Political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is going to get Wall Street's attention.
They're not going out and hiring a ton, but they're also not firing. So basically, you have a frozen labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Financial conditions versus economic conditions. There's a key distinction to make.
And that really is the key question for policy going forward.
The August Jobs Report. Friday on Bloomberg. Context changes everything.
Banker Monte de Paschi has paved the way for it to take control of its rival Mediobanca. That's after it broke through the minimum acceptance level it had set for its plan to buy the Milan-based investment bank. Now, the combination would create Italy's third largest lender. And to discuss European banking M&A and the wider banking landscape in general, I'm pleased to say we're joined by Jackie Inniker, CIO of Spring Investments. Good to have you, Jackie.
Thanks. Good morning.
We should start in Italy, shouldn't we? Because it really has been the backdrop to many of the M&A bids that we've seen in the past year. Do you think, though, that Rome has killed off the momentum, potentially, in European banking M&A?
I think, Rome, also, you could argue Berlin and also Madrid has killed off the potential. But I think, you've had the government push back in all those three places. I think the European Commission has powers to
Should it use them more?
Well, that's the thing. They wrote a sternly worded letter, I think, to the Italian and the Spanish governments, and there is it looks like there's kind of a contravention of the European merger regulation. That's for sure. But of course, Europe moves slowly, and I think this M&A moves fast. And you had a lot of commentating from politicians. One saying, the EU should stay out of this. Another one saying, using the golden powers in Italy against UniCredit in its bid for Milan has helped the French banks. What's going on here?
Well, do you think that it's the case that you need to get one of these big mergers over the line before you can get EU banking union to really gain momentum?
I'm not sure, really. Honestly, I think there's a lot of consolidation still to go within countries at the lower level, at the smaller level. You don't have to go for the massive banks to be doing cross-border consolidation. I think that's pretty much, it feels off the cards for the next few years still. But there are still thousands of small banks that issue loads of debt that are being bought by the larger banks. And that seems to be absolutely fine. Obviously, Monte and Mediobanca, they're still big banks, but that went through kind of no problem, essentially, in the end.
But on the bigger question of capital markets union, why do you think that the EU is dragging its feet when you've talked about the benefits, potentially?
Yeah, I think what Europe always needs is a crisis to move forward. And I think we've talked about capital markets union since 2015. And then, I've been doing this a long time. And then again in 2017, 2020. But what you've got now, you've got a host of political strength behind this. You had the Draghi report last year. You've got Lagarde talking about it, von der Leyen, launching consultations. And I actually think that we're making progress now. And, we've had banking union, 2/3 of it, let's say, a supervisor, resolution authority. Capital Markets Union is a little bit on a back burner, but we've got Savings and Investment Union coming forward. And there's been a big step forward there. In June, you had the changes or proposed changes to securitisation. Now, if you're going to take that kind of 9 trillion euros of deposits sitting at banks doing nothing and repurpose it across Europe, you need this, you need securitisation securitization to work more easily and freely. And that's what's happening now.
But you do wonder how much that overcapitalisation is holding back returns.
You mean the overcapitalisation at banks?
Yeah, and how much it's holding European banks back from competing with Wall Street?
Yes. I would say as a credit investor, I'm quite happy that the banks are overcapitalised. But, that's also what's driving M&A. So, I think, securitization rules are being simplified. I don't want to be deregulated. That's maybe a bit too strong. But in the meantime, that will take some time. But in the meantime, you've got banks using their capital to buy other banks. We're talking about UniCredit with Milano and Commerzbank. That's tricky. BBVA Sabadell, but there's plenty of other stuff going on at a lower level, and that's helping competition in European banks.
I also want to talk about the extraordinary demand that we've been seeing this week for corporate debt. European banks' AT1s, one of the most outperforming financial assets on the planet. Is it the case that investors are underestimating the extension risk here?
No, I don't think so. I know there's a lot of kind of hand-wringing about AT1s. This is my specialisation and what we invest in at Spring. But, we're at tight levels, spreads are tight, but European banks are as strong as they've ever been. And, I have regular calls with the ECB on the risk department there. And I'm struggling to think of where the vulnerabilities are in European banks right now. I could name a few, but then not really. We're going to get a correction in the market.
Yeah.
Absolutely. Is it going to come from the European banking sector? No, I don't think so. It's going to be some geopolitical thing or maybe a rates thing. It won't directly impact European banks, certainly not European banks' credit. What we're talking about, equity is different, but credit, AT1s, they'll drop, they'll come right back up again. So there's a risk of not owning this sector, being out of it and being in cash.
Okay, and just where are you finding value in AT1s at the moment?
It's very tricky. My co-manager guy's always looking for these great trades, and at the moment there's such compression. You'll see the Greek banks trading through Credit Agricole. We did a trade earlier this week, to pick going out of Alpha into Agricole. But where I think the best value is more the second-tier banks. Kinda mentioned it earlier. There's a lot of consolidation going on. And the smaller banks that aren't in the Bloomberg indices, those are the banks where there's a lot of value. They're acquisition targets. You're seeing this slight deregulation in Europe, particularly in the UK. And those are names like, Metro in the UK. There's a couple of other names in the UK that we've been buying recently. And you can still get low double-digit returns there.
And just quickly, what are you selling?
Well, I have to say we're selling the Greek banks. I love them, but they should not trade through Credit Agricole or Lloyds.
All right, Jackie Inniker, CIO of Spring Investments. Lovely to have you for a Mancunian reunion around the table. You'll have to come back. I just want to mark what's happening in the oil market, because you're looking at Brent at $67 a barrel, pairing this loss. And this is after Russia has said that there'll be no current OPEC plus hike talks. So, of course, we were braced for a potential another supply hike, but Russia, for now, ruling that out. So we have Brent weaker, 0.9% in response. We've got plenty else to watch in these markets. The Stock 600 up today, up 0.25% as things stand in this session. But we're seeing some of the weakness for Sanofi. Shares plunging after a disappointing trial for its new dermatitis drug. So we're going to bring you the details on that stock and the disappointment next. Shares down more than 9%. Stay with us. This is Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Rate cut optimism. Weaker than expected US jobs data cements bets that the Fed will ease policy later this month. Bonds trade higher as calm returns to Europe. Elsewhere, China looks to cool market speculation as concerns mount about a rapid $1.2 trillion rally. Plus, Sanofi slumping after a new eczema drug disappoints in a late-stage trial, sending shares down as much and more than 9%. So, Sanofi shares down sharply after that news. We can get more now with Bloomberg's health reporter, Ashley Furlong. Ashley, how critical is this drug for Sanofi? Because this is a big move.
It's really vital to the Sanofi's pipeline. So the top-selling drug for Sanofi is Dupixent, which also treats similar conditions, atopic dermatitis, asthma, and the hope was that this new drug would somewhat replace that revenue. Dupixent comes off patent in 2031, so everyone's looking to what comes next. Sanofi has a pipeline of drugs, but this was really critical for replacing Dupixent. And the results have really disappointed because they don't meet efficacy of Dupixent.
And is there anything in that pipeline that analysts are thinking could help Sanofi actually make a comeback from this?
Well, it does have a drug for multiple sclerosis that has shown some positive results already. But then earlier this year, it had another disappointment in a drug for COPD, which is a lung condition, a deadly lung condition. And analysts are also a bit nervous about the outcome of that and whether that drug will be approved in the conditions that it wants to be. So there's concern about the pipeline. But it is a significant pipeline, and there are lots of drugs that are still in development. So it is wait and see, really.
Well, yeah, of course, the CEO, Paul Hudson's been really throwing money at all of this R&D. Do you think that this trial is anyway going to hold that back? Do you think it changes the view on M&A at all?
I don't think so. I think, if anything, it might sort of make Hudson even, it's more critical for them to actually find the next blockbuster. Yeah. And we've seen already several deals in the past couple of months from Sanofi, and they've said that they have money to do additional M&A. So I think we can expect more of that later this year, potentially.
Ashley, thank you so much for taking us through that. Bloomberg's health reporter, Ashley Furlong. We've seen the shares, as I say, down about 10% in early trading, but down about 18% over the past 12 months. Let's get you to some of the other top stories this morning. President Trump is asking the Supreme Court to uphold his global tariffs in a fast-track case that could reshape trade policy. According to filings reviewed by Bloomberg, the appeal calls for putting the case on a highly expedited schedule with arguments in early November. It follows a federal appeals court decision that said that Trump can't impose wide-scale import taxes by invoking the 1977 law that was designed to address national emergencies. Now, elsewhere, the Trump administration is moving to block 2 Iberdrola offshore wind projects in Massachusetts that are worth nearly $15 billion. A court filing shows that the government's pulling permits for the New England Wind 1 and 2 farms, part of a broader crackdown that's disrupted at least 4 East Coast projects this year. And we have tech industry leaders expected to attend an artificial intelligence event hosted by the First Lady Melania Trump that's happening later today, and then to join the president himself for an evening reception in the newly renovated Rose Garden. Meta's Mark Zuckerberg, Apple's Tim Cook, and Microsoft's Satya Nadella are among the invitees. And staying with Apple, Bloomberg has learned that Apple is planning to launch its own AI-powered web search tool next year. Sources say that the company is working on a new system dubbed internally as World Knowledge Answers, and that's going to be integrated into the Siri voice assistant. The move would allow Apple to compete with OpenAI as well as with Perplexity. Now, our next guest sees a future where economic growth won't come through an increase in employment. Eloquent AI is looking to automate complex customer operations in financial institutions and especially in banks. Now, they just raised $7.4 million seed round in 3 days. Wow. And we can talk now to the CEO and founder, and that is Tuğçe Bulut. Really good to have you with us, Tuğçe. Thank you so much for making time for us. Look, we've got everybody using AI now. I wonder, how do you use AI to get the edge in banking?
That's a fantastic question. I'm sure any of us here have called our bank in the last maybe 24 hours, maybe 1 week, and we waited on the line for maybe 45 minutes before we can actually speak to someone. The way the banks use today to completely transform their not only customer support and operations, give a premium level access like a concierge service to every single customer they have, which used to be only a privilege for a few of their customers.
Tuğçe, you're triggering me here. You're making me think of hold music. But look, what's the difference between what you offer and a chatbot?
The Eloquent AI solution offers an AI operator. It was all a transition. We started with chatbots, but I would admit I found them quite frustrating. You go and start speaking to a chatbot and it doesn't understand what you are saying. You have to press buttons. It's not a natural language conversation. Then we saw agentic AI, which is a little bit better, but the problem was it was simply conversational. It couldn't actually take any actions. It couldn't really respond to the requests you were saying. For example, my ACH transfer is stuck. It's been a couple of days. Why is it not going through? Chatting in those circumstances is not enough. You need to be able to log in to a core banking platform, bring up the customer's account, look at if there's any fraud, if there are any risk flags on it, and click a lot of buttons, make decisions, make judgment calls. That's what AI operator, our Eloquent AI operator, does. It effectively acts like a human. That's why a lot of our customers call it a human API. And it can take all these actions in a very complex, regulated workflow.
But we've been talking about what Apple's doing on AI, what DeepSeek's doing in AI in just this program, Tuğçe. So I wonder, when these more generic platforms become more advanced, are you not worried that they're going to overtake you in your own field in banking?
That's a fantastic question, and it's quite interesting. OpenAI's own CFO recently gave an interview talking about the fact that they are not set up, their agentic structure, their generic training is not set up for vertically specialized tasks. And where we see the real moat is that you are doing a job which is for a very specific task, like doing a risk check, sanction screening, alert dispositioning for a bank. And the way we train our own model or RTO can be very opinionated, because we are not trying to solve the problem for every task. We are trying to solve this problem with 100% accuracy and reliability, but for a very specific problem. And you are doing that with proprietary data that is behind the walls. It's not publicly available. It belongs to the companies who are doing these actions. So it becomes quite a differentiating edge.
But you've just talked about a load of jobs that humans usually would be doing. And I speak to economists day in, day out, analysing the latest labour market data, talking about how no one wants to hire or fire at the moment. There's an absolute freeze. And many of them say, look, it's not just about tariff uncertainty. It's also because you've got AI doing human jobs. Is that not the ugly truth here, that what you're offering is going to displace humans' employment?
First starting point, what we are going to see for the next couple of months, maybe for a year, is the companies will be able to double their revenues, triple, grow significantly without going through headcount growth. And in a time where there's so much pressure on the bottom line, that is a very welcome change on the side of the banks. What that means for the overall labor market is we do need to prepare for a new world where work is optional and no longer a precondition for your subsistence. It wouldn't be surprising at all in 2 years, 3 years, we actually move on to a place where us humans get to choose what we do rather than having to do very routine tasks 100 times, 1,000 times a day. In our very nature, we are actually not really built to do those kind of jobs. Our human potential is far greater than that.
Yeah, you just wonder how many of those fun and clever needing jobs are actually out there to say. But I just want to also take a step back, because you've got a really interesting perspective here. You're headquartered stateside, but you're registered here in the UK. What do you make of the difficulties, shall we say, of being a European tech company and growing compared to if you're an American tech company and growing in this environment?
Absolutely. I mean, just as a starting point, we are a fully American company. We are based in San Francisco and we are registered in Delaware. You're absolutely right. We do also have operations in London. And, I lived in London for many years. There's incredible talent in London that we want to continue to tap into. But we are an American company, and the largest market for this change is being requested in the US. That's why it's quite important to be based there as you are expanding this technology. It's a great starting point. Now, we have fantastic UK customers already. One of them is Clio, for example, also based in the UK, but very successful in the US. And some of these UK companies are also preparing for their IPO or going through incredibly fast growth periods. We are able to support them also being compliant with the regulations here in the UK.
Tugse, we'll have to catch up again next time you're in London. Tugse Bula, CEO of Eloquent AI. Thank you so much for joining us this morning. Well, coming up on the programme, we are going to stay in the UK. Bank of England Governor Andrew Bailey playing down the surge in long-dated gilt yields and talking down the chances of another rate cut this year. He's had a lot to say, and we're going to discuss it next. This is Bloomberg.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bank of England Governor Andrew Bailey's played down the importance of a surge in long-dated gilt yields, saying that he wouldn't exaggerate the significance of 30-year bond yield moves. Now, he's also cast doubt on another rate cut later on this year.
Although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps.
Well, Kit Rees, editor of Bloomberg's Markets Today live blog's been listening to that testimony, so you don't have to. Kit, what were the other MPC members saying? Do you feel like everyone's as hawkish as Do you feel like everyone's as hawkish as the governor sounded there?
Yes, we've definitely been getting a bit more of a hawkish tone from the members for yesterday. So there were comments from Deputy Governor Claire Lombardelli, which people have been focusing on. She said that the rates may need to settle only below 4%, which is the current level. There were also comments from Megan Green, definite concerns over inflation, which seems to be what they're focusing on. So this seems to be chiming with what markets are thinking. We've seen bets paired on a rate cut in November. So this was all kind of fitting into that picture, a very cautious picture. Inflation has been very persistent, and yet there's worries over growth and, possible slowdown in the labour market, which is, again, another thing that the Bank of England is focusing on. So taken all together, it was a bit more hawkish comments. We'll have to see what's going to happen in September at the Bank of England meeting there to see how their thinking has evolved.
Yeah, I'd been dying to hear from Claire Lombardelli. It was her first time speaking and explaining that dissent at the last meeting. Of course, they had to vote again, didn't they? But look, on the fiscal side, now we know we've got this budget coming also in November, end of November, 26th of November. Why have they pushed it back so far when you've got all these moves at the long end of the gilt curve?
Yes, so it's a great question, and it looks like the government will probably want to get a bit more of a steer on what's going on with the economy. So there's obviously lots of worries over a slowdown in growth. As I mentioned, inflation has been persistent, but there's been other signs of weakness elsewhere. So it gives them time to see how things have evolved. There's also a lot of risks with tariffs on the kind of global front, geopolitical risks too. And we've also got lots of data points coming up. We've got inflation, Bank of England meetings, so lots to navigate. So the government will probably be one to see how this all evolves, and then how it will feed into into fiscal policy.
And they're also watching how the situation evolves on the Deputy Prime Minister, Angela Rayner. So she's fighting for a future, isn't she? She's admitted to having underpaid property taxes. You've got to wonder how much concern that political uncertainty is going to cause for markets.
Yeah, markets don't like uncertainty at all, but we haven't seen huge moves just yet. So markets seem to have been quite sanguine. Yesterday things stabilised, seeing a bit more of a stabilisation today. But if we see any further developments on the tax probe, or we see any more kind of concerns over leadership, then that might start to filter in, maybe into the pound too. But looking forward, it's going to be also interesting to see how the domestic stocks perform in the FTSE 250, given and they've underperformed this year. So lots to watch, but for now, no big real moves yet.
Well, I'm sure you'll be tracking those moves on the blog. Kit Rees there, editor of Bloomberg's Markets Today. We thank you so much. Now, we've been talking about this reprieve for Treasuries yesterday after US jobs data prompted traders to add to bets on at least 2 Fed cuts this year. But if we zoom out, over the past year, long-end yields have continued to move higher. And Jamie Rush from Bloomberg Economics argues that those higher long bond yields are here to stay. Jamie's here to stay with me now. Jamie, good morning.
Morning.
Just give us some perspective here, because when we've been talking about, let's say, the wild moves on the gilt curve, it doesn't seem like we're in a Liz Truss moment. So just ground us a bit in what's happened this week.
Yeah, I mean, I think we're not, because if you look at where the action is concentrated, it is, as you say, at the 30-year horizon. Back in the Liz Truss deep, dark times, it was spread across the yield curve. It was, the pound was selling off at the same time. That's not happening this time. So
in a big way.
Not in a material way, yeah. I mean, if you looked at it back then, they were both moving in the opposite direction. So it was bad news. So I think what we're seeing is idiosyncratic factors that are driving yields in like 3 countries. So you've got Japan, UK, France, yield curve control and fiscal in Japan, bit of fiscal here, a lot of politics in France. These are intensifying moves at the 30-year horizon, but it's happening everywhere. It's just that, that it's particularly bad in those countries.
But what's connecting the dots then? You've got, as you say, the Fed story in the US, the fiscal story in France, but it's all happening together.
Yeah, I mean, I think the underlying trend is driven by things that are happening behind the scenes. It's the structural forces which are pushing rates higher over many years, not the current market focus, which is at that 30-year horizon.
And indeed, in your book, your new book, The Price of Money, you've written it with our colleagues Tom Orlick and Stephanie Flanders, which you can see there on the screen. You say that 4.5% 10-year Treasury yields is the new normal. I just wonder how much higher we can go, given all those factors that you're citing.
Well, so I think when you dig into the reasons why interest rates fell over the past and throw them forward, I mean, why do they fall? Demographics. So the baby boomers socking away their paychecks into savings accounts for their retirement. Well, they're retiring. So less savings, higher interest rates. We used to think we lived in a safe world after the end of the Cold War. Defence budgets shrunk. Governments were able to save. Well, we don't live in a safe world. Defence budgets are going up, creating more pressure. And if you think about AI as well, I mean, to really benefit from these frontier technologies, you have to throw a lot of money at it. There's a lot of investment. More investment, higher rates. So if you put those things together, I mean, these are not all going to happen at the same time, but they're all pushing upwards on rates. And you can easily imagine a path where instead of sort of 4.5 10-year Treasury yields, you could get to 5 and above, and it's not that hard to picture it.
So in the here and now, we were talking to Eric Lonergan at Calibrate yesterday, and he was saying on the opening trade, look, the sell-off in gilts is more about psychology among investors than, the fiscal concerns that we were talking about. Is that basically what we should conclude?
Well, I think that's broadly right. I mean, the UK is not a basket case. It's not in a significantly worse position than France or the US. The UK is not a basket case. No, there's a lot of positive things to say about the UK, and there's probably some the management of the messaging is probably not quite what you'd like it to be. But I mean, I think the bull case for the UK still stands, and so I wouldn't expect it to be completely a complete outlier forever.
Well, I'm sure the Chancellor would thank you mostly for that message. Jamie Rush, our Director of Global Economics at Bloomberg Economics, thank you so much. And The Price of Money is published next month, so do pre-order your copy. Well, pivoting to the US, former Treasury Secretary Larry Summers warned that while financial markets have so far shown limited concern with regard to the Fed's independence, the situation could, in his words, turn very quickly. Summers was speaking to Bloomberg TV's Wall Street Week.
What the president is talking about, what he's explicitly scheming about on his Truth Social account and in some of his rhetoric, is getting a majority of the Board of Governors and using that majority on the Board of Governors to force a majority on the Federal Open Market Committee by controlling the appointment of regional feds. So this is not a one and done thing involving just the chairman. This is an attack on the governance of the institution. There hasn't yet been a dramatic market reaction. There are some concerning things in markets, not just 1 year ahead, but 1 year ahead. Inflation expectations are trending up a bit. The spread between the 30-year bond and the 10-year bond is larger than any time since COVID. But we haven't seen substantial reactions in markets yet. But this could turn very quickly if the psychology changes.
Former US Treasury Secretary Larry Summers speaking there. Well, staying with the Fed, it says that US economic activity saw, quote, little or no change across most of the country in recent weeks. Traders are hedging their bets on Fed cuts later, a Fed cut later this month, with Friday's payroll data seen as pivotal for year-end bias. Let's bring in our Ven Ram MLive strategist, of course. Ven, good morning. What do we take away, first of all, from the latest Beige Book and the JOLTS data yesterday? Because it looks like this is what's supporting the Fed cut bets and the market this morning.
Morning, Lizzie. Absolutely. I think that the big takeaway from the Fed Beige Book was that, look, economic activity is more or less stagnant in the world's largest economy. Most of the districts reported flatlining economic activity, but at the same time, they are concerned about the increase in price rises. They're concerned about wages not keeping up with inflation, and that continues to be, that will be a key driver of the markets going forward, I think, because much of the inflation that is going to come down the pike, I don't think is fully factored in by the markets. So I think that, the Fed is going to cut rates from to all intents and purposes. Yesterday, we saw the JOLTS report showing a softening of economic activity as well, and softening of the labor market as well. So I think that the Fed is now more minded about the employment aspect of its mandate. So I think that they are going to cut rates. Let's see what this leads to.
Well, could the payrolls data tomorrow open the door to a 50 basis point cut in September?
Well, I think that that is unlikely to happen unless we get a contraction in the jobs market, which of course no one is expecting. If the jobs market data prints as expected around 75K, I think that we should probably get ourselves ready for a 25 basis point cut, which is what the market expectations are. I don't think there is really a case for a 50 basis points jumbo rate cut yet. There's nothing in the economy that is screaming for a rate cut as big.
So is the bond market sell-off now done, then?
Well, it has happened in fits and starts this year, Lizzie, really. We saw one episode in January and then one in April in the UK. And this week's selling has certainly abated, and it looks like it is going to be contained for now. But, come the end of November, when Chancellor Rachel Reeves is going to unveil an autumn budget, I think there are some very uncomfortable questions for the government to answer vis-a-vis the gap in the government finances. So I think that as that comes into the crosshairs, I think that gilts will once again come under focus, especially the long end.
Well, yeah, she's picked the day before Thanksgiving, Ven, a time of low liquidity. Surely that's going to wreak some issues in the market.
Absolutely, and I think that much of the selling may in fact happen before she unveils her autumn budget. But of course, she's chosen the time, and which, as you mentioned, colludes into a period of low liquidity. So I think that, it's going to be a very jittery year-end for the gilts market, specifically those who are positioned at the longer end of the curve.
All right, our MLive strategist, Ven Ram, we thank you so much for that analysis. Do check more of it out on the MLive blog. But that does it from me with the pulse. Coming up next, Bloomberg Brief. We'll hand over to Vonnie Quinn. So stay with us. This is Bloomberg.
From the world world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed, and there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Legal headaches abound. President Trump asks the Supreme Court to uphold his global tariffs. The AI race heating up. Apple plans a web search tool. DeepSeek builds an AI agent. And investors await more jobs data after cooler than expected jolts. So let's take a look at where we stand markets-wise. A little calmer today. We had futures actually pointed higher, perhaps thanks to a little calm in the bond markets as well. Although we did get some earnings after the bell last night, it should be said that were a little disappointing from some of the tech companies. I'm looking at you, Salesforce. But look at the 30-year yield. We're down to 4.88. Remember, we're just literally within 0.003 of 5% yesterday, so that's quite the move in U.S. bonds. We did just have a series of French auctions, seems to have been mixed to not so bad. We'll get into that in just a few moments. Commodities-wise, we are looking at a day of losses for gold. That is the first in 8 days, so 7 days of gains, and now we're just off those highs. But bear in mind, we're still above 3,500 a troy ounce, and we have Goldman Sachs today saying that we could get to 5,000, in fact, if certain things, including the Fed, don't go well, including Fed independence in particular. Brent crude 67.02, waiting on that OPEC Plus meeting, continues to decline. The US dollar index relatively unchanged. So let's get to some individual stocks to watch today now. Let's get over to London and Valerie Teitel.
Bonnie, I wanted to start with Salesforce. That's not what behind me, but Salesforce is moving lower in the pre-market. Here we go. We've got Salesforce down 6.8%. This is off the back of forecasting some pretty weak guidance. It seems like their investment in AI infrastructure, these AI tools, is not paying off as quickly as expected. And investors are starting to get worried that these incumbent software makers might get beaten to the punch by new AI vendors. Let's move on to our next stock. That's HP, they're out with results after the bell last night. And this is a bit of a mixed picture here. They gave some guidance that their margins are going to come under pressure, but the CEO expects them to be boosted by the end of the year. And investors are seeing the free cash flow, a boost to free cash flow in 2026. So we are trading higher on HP, up 3%. Lastly, I want to check on American Eagle. This was another stock to report. They are showing that Sydney Sweeney ad was more than successful. American Eagle flying off the shelves, as well as those Sydney Sweeney jeans, up 22, nearly 23% in pre-market trade. Bonnie, the CEO is saying that they gained a customer in every single county in the U.S. in the previous quarter. Bonnie.
Wow, that is a statistic that bears thinking about. Valerie, thank you so much. That's Valerie Titel. And in just moments, we're going to catch up with James Athey of Marlborough on market risks in the United States in particular. And Stephanie Guild of Robinhood joins us later this hour on opportunities in stocks. Fed Governor and potentially Fed Chair candidate Chris Waller once again advocating for rate cuts to begin this month, plus more reductions in the coming months. James Athey of Marlborough agreeing to that call, writing, quote, "We think he's right. The labour market is key to the self-propagation of price pressures. Thus, we like 5 to 10-year treasuries with no exposure beyond the 10-year. James joins us now. He's fixed income fund manager at Marlborough Investment Management. So, James, with absolutely nothing in the long end, particularly the 30-year, how have you been reading the last couple of days of moves?
Yeah, morning, Vonnie. It's been really interesting, hasn't it? Obviously, we've seen a pretty sort of coordinated or coincident sell-off in long ends across the globe, really, and there's lots of subtle distinctions between these markets, but I guess fiscal policy is really the one challenge that all economies have, and I think that's probably one of the most significant reasons why 30 years have been struggling for quite some time now, and it's certainly one of the main reasons that we've been avoiding that area in the big G3 markets.
Yeah, I mean, it's interesting, though. You were looking at them in Japan, so I'm wondering what you make of this Japanese move, and is it over now that it's abating? Not quite as much as in the United States, but still abating.
Yeah, obviously Japan has been the sort of poster child for kind of fiscal incontinence and massive government debt balances. But actually the nominal growth they've had over the last few years since the pandemic has really started to improve their debt to GDP trajectory. When you look at debt on a net basis in Japan, it's nowhere near as worrying. It's sort of 160% of GDP area, still not great, but nowhere near as bad as the gross debt numbers look. And ultimately, we just think, you know, Japanese domestic savings are still huge. It's still a domestically driven market. And these large institutional players that have been chased offshore over the last 10 or 15 years are starting to see, and we think will continue to see, the incentives for them to invest domestically increasing and increasing probably quite dramatically. So it's been a bit painful for us in the short term, but this is a position that we think really has structural sort of positive outlook. So we're going to continue to hold on unless something more significant changes.
So back to your Fed call then, James, you agree with Chris Waller that several rate cuts are necessary over the coming months. I'm curious, do you see a possibility of a 50 basis point rate cut this month?
Yeah, it's interesting. Yeah, I heard Lizzie just then asking Ben about 50, and he sort of said it was unlikely, I guess, unless there's a contraction. I think we'd probably agree with that. I think if we get a really negative payrolls print, as we know from history, that starts to sharpen the focus of some of those minds on the FOMC who are wavering. And of course, the trade-off between growth and inflation probably shifts quite significantly towards managing the broader economy rather than, you know, what are really difficult to analyze price pressures in the short term. And certainly, I don't think we're talking about the sort of price pressures that we saw after the pandemic. And as I said in the quote that you just put up on the screen there, you know, it's really about the labor market when it comes to the sort of self-fulfilling inflationary process that central banks really were sort of made independent to specifically deal with. So, yeah, for us, the labor market is absolutely key. If we get a big negative 50s on the cards, but we're not expecting that.
Yeah, so there's a lot of questions about tomorrow's data. Consensus saying 75,000 jobs created and the unemployment rate will tick up to 4.3%. What would it take? I mean, I guess you've just told us a negative print, I suppose, for the market to be surprised. Could we get, you know, something on the other side of things? Could we get, you know, way more jobs created than we would have expected? And then just on a separate point, we have a new BLS chief. Do you think that on the margin that makes any difference to this report?
Well, that was the point I was going to mention, is that I guess our certainty, we've been really skeptical of payrolls for more than, for years. I'm not counting it in months, for years. Broad labour market indicators and payrolls have been in disagreement for a long time. Certainly the household survey relative to the establishment has suggested some issues. Some of that, I think, is migration, but I think some of that actually is just the difficulty of but also the birth-death adjustment that the BLS makes to its payrolls data, and the sort of knowledge that we have that inflections of the labour market that can misstate jobs quite significantly. We saw that in 2006, 7 and 8. So we've been a bit sceptical of the payrolls data, and that always raises a question mark. Now we've had this change in the BLS, then really that doubles the uncertainty. Of course, the statistical significance of misses in either direction is it has to be quite a large miss, but markets don't tend to take it that way. So we think there is probably actually a sort of hawkish asymmetry, because the market does seem set up for a weak number. But I don't think we'd be surprised if we see some data which changes our sort of trend view of this softening of the labour market.
What about next week's inflation data? Does that have the possibility to change your mind?
Yeah, I mean, of course, you have to consider them together. The Fed, of course, has a dual mandate, and so everybody treats them as sort of two sides of the mandate that they have to judge in comparison to one another. And of course, what we know is that price pressures today is not necessarily indicative of where price pressures will be at the Fed's policy horizon, because if the Fed makes policy changes today, the impact on the economy is not fully felt for many months, possibly over a year. So that's what makes it doubly difficult. I think from a market's perspective, of course, markets will be jumpy and jittery based on inflation, and we would expect to see, a sell-off in rates if the number's higher, and then vice versa, a rally if it's lower. But again, I don't think the inflation data that we're about to see is likely to shift the narrative as much as the jobs data could.
All right, 5 to 10 years with no exposure beyond tenure. Once again, James, thank you so much. James Athey of Marlborough. Now on to other top stories trending on the terminal this morning. Apple plans to launch its own AI-powered web search tool next year. Sources say the company is working on a new system that will be integrated into Siri. The service will enable users to look up information across the internet, much like in ChatGPT and AI overviews on Google Search. Harvard University has scored a major legal victory in its battle with the Trump administration. A court ruled that the U.S. illegally froze more than $2 billion in research funding. The ruling paves the way for the funding to be released to the school, but the judge didn't order that. Harvard has been the main target of President Trump's efforts to reshape elite higher education. European leaders are currently meeting in Paris to finalize discussions about security guarantees for Ukraine. This all comes as President Zelensky says that Russia had relocated 100,000 soldiers to the front line outside Pokrovsk, which the Kremlin's forces have tried to seize without success for more than a year. Coming up, Chinese regulators weighing possible measures to cool its stock market. We'll discuss next. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
This is going to get Wall Street's attention.
They're not going out and hiring a ton, but they're also not firing. So basically, you have a frozen labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Financial conditions versus economic conditions. There's a key distinction to make.
And that really is the key question for policy going forward.
The August Jobs Report. Friday on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Bloomberg sources say that China's financial regulators are considering a number of cooling measures for the stock market. This comes as concern grows over the speed of its $12 trillion rally since the beginning of August. That's a $1.2 trillion rally, which makes a lot more sense. Joining us now is Bloomberg's Shuli Ren. Shuli, it seems like it's only a couple of years since we saw President Xi try to crack down on things like online gaming, online education, and so on. Is that the type of move we're going to see now?
I think President Xi Jinping, of course, he was not known for caring about stock market returns, but I think he probably has changed his mind by now, because what we are seeing is in the last 5 years, China basically entered into a fertility crisis. Before the pandemic in 2019, about 15 million new babies were being born every year. And then last year, and it was a very good year for China, not even 10 million babies were being born. So what we are seeing is that in the next 20 years, we'll have 1 new worker supporting 3 new pensioners. China just at the current stage cannot support its social security system. So the question is, how can President Xi, who might be living up to the year of 150, make sure that the Chinese elderly have nice retirement years? As we know, like the housing market is not doing very well. The value of home prices is not going up, right? Like the economy is not doing very well. The pension system is overburdened. The only way for the retirees to have a nice retirement is to see nice returns from the stock market. That's why I think at this point he starts to care about stock market returns.
So we're just going to show a chart on television which shows China curbing speculation at 2015 levels. So obviously the total outstanding balance of margin transactions there is the yellow line. The CSI 300 is the blue line. Shuli, is there anything about this that's like 2015?
There are a lot of similarities. This is a liquidity-driven rally, but the retail investors are not entering the market to the extent of 2015. Of course, the government is also very worried that this rally is going too fast, right? Like if they want to entice foreigners and the retail investors to put their monies into a stock market, the rally just cannot go too fast, too crazy, because people will just sit on the sidelines. That's why you start to hear that the regulators want to slow down the bull market. But I do think that the regulators need to be very careful, because what happened in 2015, 10 years ago, was that their policies were too heavy-handed. And that just killed the rally. And actually, China's stock market went into a bust, right? This time, they need to be softer and have more gentle approach.
Yeah, I mean, it's become a little dangerous, right? If we take a look at Cambricon, for example, it's an AI chip designer. If we take a look at its share price move over the last couple of months, it's just been absolutely booming, and particularly in comparison with the CSI. In fact, the company warned investors last week about risks in trading its stock. We're going to show that chart. I'm curious, what can President Xi do about something like that?
I think what they need to do is basically this year, China has this so-called national team. Basically, in the past, they came in when the market was in the rout, right? This year, the national team actually formally established their presence in the stock market. They say that we are actually the national team trying to come up to support the China's domestic equities. And I think what they need to do is to gradually pull some liquidity out of the blue chip index funds, and the investors will look very carefully. They will know that the government doesn't want a very fast bull, and they will start to taper down a little bit. But again, they need to be very gentle about this. Otherwise, it's just going to be a repeat of 2015.
All right, it's going to be fascinating to watch this play out. Shuli, thank you so much. Fantastic columns on Bloomberg Opinion, of course. That is Bloomberg's Shuli Ren. Coming up, President Trump asks the Supreme Court to uphold his tariffs. That and a look at what else is making headlines in your front page news. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, it will provide a very strong market.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up on the BBC, police are investigating a tram that derailed and killed at least 16 people in Lisbon. Authorities say more than 20 others were injured, with 5 in serious condition. Local media in Portugal reporting suggests a cable came loose along the railway's route, causing it to lose control. Next up on the Washington Post, new legislation headed to the governor in Texas that allows anyone to sue doctors and distributors of abortion pills. Winning plaintiffs would get a minimum of $100,000 in damages. Governor Greg Abbott is expected to sign the legislation into law and aims to stop the flow of pills into Texas from blue states. And the Trump administration says it was, quote, very worried by the Norway oil fund's share sale of Caterpillar because of its activities in Israel and has protested directly to the government in Oslo. The world's largest sovereign wealth fund revealed it had sold out of the U.S. company last week. Switching focus now to trade. President Trump has asked the Supreme Court to uphold his global tariffs. Trump wants the court to overturn an appeals court ruling last week that judged his global tariffs illegal. For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, we were expecting this action. What is the timeline now?
Yeah, it's a fairly quick timeline. The administration's attorneys have asked the court to decide by the middle of next week that it will take the case up or not. It is widely expected to take the case up, and then if that's the case, we will see the justices perhaps hold hearings and hear both sides of the case sometime perhaps in November, and then the earliest we could see an actual ruling would be by the end of the year, maybe, or perhaps even into the first quarter of 2026. So this isn't going to be resolved in the next few days or weeks. We're looking at several more months of this tariff uncertainty sort of hanging over the global economy, and in particular, U.S. importers who have to pay the tariffs.
Yeah, and as we know, oral arguments tend not to be what sways the Supreme Court. So are we looking at filings? How are we going to know what the arguments are on both sides and what kinds of questions Supreme Court justices are going to be asking?
Yeah, exactly. I mean, if the administration's public comments recently are any guide, they are going to make this case that this is the centerpiece of President Trump's economic agenda. These tariffs, this particular kind of authority that he's using, to these reciprocal tariffs, and that if they were to rule against him, that it would cause so much disruption to the economy, to the trade negotiations and the deals that he's been working on with various countries, and then to the revenue that's pouring into the U.S. Treasury from the collection of these tariffs. So it seems like the environment they're trying to create is one of incredible disruption. They've even talked about, chaos and if the court were to rule against the administration. So we'll have to wait and see what exactly their legal case is as they make it directly to the court. But for the time being, they're saying, look, this is going to cause a lot of problems if you rule against us, and the president isn't allowed to use those tariffs to carry out his economic agenda.
Yeah, I mean, in some ways, that's not the Supreme Court's problem, right? It's the Supreme Court's problem to just adjudicate on this. Is it a binary outcome? So the Supreme Court upholds the ruling, and we all have to figure out how we're going to get refunds, and the Treasury suddenly doesn't get, revenue anymore, or the Supreme Court overturns the decision and the tariffs all stay in place?
Yeah, we'll have to see how it all plays out, and we're in the very early days of the actual process as it gets to the Supreme Court. There are some analysts that will tell you, look, the justices ideologically will lean in the White House's direction on this, that broad interpretation of executive authority. But then there are those who will say, look at the rulings, the various cases that the president has lost in lower courts, and the justification for those, that the statute he's citing to justify these tariffs doesn't use the word tariff, it doesn't use the word tax or levy or anything that would imply that the White House has the authority to tax American corporations that import goods the way this particular mechanism does.
Brendan, thank you so much. That is Brendan Murray there in London. Coming up, we're going to be catching up with Robinhood CIO Stephanie Guild. That is next. Do stay with us. This is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Legal headaches abound. President Trump asks the Supreme Court to uphold his global tariffs. The AI race heating up. Apple plans a web search tool. DeepSeek builds an AI agent. And investors await more jobs numbers after cooler than expected JOLTS data. And indeed, that may be what is making sure that futures are equivocating today. Yes, we are pointed green, but essentially markets are very likely to be waiting for tomorrow's non-farm payrolls report. Consensus, of course, looking for 75,000 jobs created and the unemployment rate up to 4.3%. We'll get another reading today with initial jobless claims. And of course, we get ISM services today as well. And we have to read those mixed earnings into the picture too. Salesforce in particular disappointing. We can see that the 30-year yield, though, is down another basis point after yesterday's decline. Remember, we've come down now all the way from almost 5% to 4.88, so there may be a lot of calm in the bond market. Let's look at commodities because we're seeing continued weight in oil as OPEC Plus looks likely to potentially increase supply again at the weekend. Gold ending its winning streak. Is that a good thing or a bad thing? I'm not so sure. We're still above the $3,500 a mark, though, and one announcement, Goldman Sachs saying we could actually reach 5,000. That's if Fed independence is damaged. That's in a new note today. Let's get to some stocks to watch now, though, and cross over to London. Here's Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with Salesforce. As you mentioned, some disappointing sales guidance from the company. The stock is down 6.6% in pre-market trade. This is making investors nervous that these incumbent software players might get beaten to the punch by new AI vendors into this space. This heavy investment in AI tools seems not to be paying off as quickly as Salesforce hoped. Let's stay in earnings and move over to HP Enterprises. A bit of a mixed picture here. They did have some pressure on their margins, but the CEO saying that they should return to their regular range by the end of the quarter. Analysts also predicting a return to some great free cash flow in 2026. We're seeing shares of HPE up some 3% in pre-market trade. Lastly, some more earnings for you. American Eagle coming out with a big jump in sales thanks to that Sydney Sweeney ad. These shares are flying up 23% in the pre-market. The CMO, Vonnie, said that they gained a customer in every single county in the U.S. due to that sellout of their Sydney Sweeney jeans. Bonnie.
And of course, we get Travis Kelsey for next quarter. Valerie, thank you so much. That is Valerie Teitel in London. Robinhood CIO Stephanie Guild looking at stocks beyond the Mag 7, writing, quote, It may be tough to see the S&P much higher from here, but market opportunities below the top 10 could still go higher, especially with rate cuts. I'm pleased to say Stephanie joins us now, and she is in studio. So Stephanie, that looked to be the case, and then we had yesterday where we saw plenty of disappointing earnings in the space that surrounds these companies, at the very least. I'm looking at you, Salesforce. Do you still see opportunities?
Oh yeah, for sure. I mean, yeah, Salesforce has been one of those conundrums, I'd say, for many portfolio managers, because there's so many good things behind the company, for example, but you know, in this market, you can't have one bad thing, I should say, in their report, and really guidance was the thing there, and it's disappointing. But I think you've seen that across the board. You saw that last week with a number of companies, but then you also get companies that outperform expectations, like Pure Storage, you know, a week or so ago. So
yes, and that is one of the companies that you particularly like, along with Uber as well. And obviously Uber has been in the news. You know, some other prominent investors also like the company.
Yeah. I mean, if you just think about, like, what are people going to continue to use versus not use in the face of potential inflation? And if you don't get inflation, then you have margin compression. So where can you kind of see consistent usage no matter what? And Uber is one of those. Pure Storage, we think, is going to be a place that has to continue to be used, considering AI is, I mean, it's the one thing that's growing rapidly here in the U.S.
Another trend, though, that is sort of taking on, if you like, is the banks, particularly as we look at what the Fed might do next. And I've noticed you're liking the banks at this point too, particularly regionals. Give us the thesis on that.
Yeah, I mean, I think it's threefold. One is that if you think about, like, you really have to focus on fiscal policy, and one of the legs of the stool that they have is deregulation, which hasn't really been a huge, I think, move for them, but at some point will be. And I think it will be most prominent in the financial sector, particularly in banks, because that's been the most regulated over the last decade plus. In addition, I think you will continue to see a steepening yield curve, which we've started to see really kick off in the last few days. And I think a steep yield curve really helps banks in terms of, you know, low interest rates on the low end and higher interest rates on the higher end. And then I think it's just a matter of, I don't think we'll see a major recession or major growth slowdown, although obviously that's in flux right now, and banks should continue to benefit from that.
Why do you say particularly regionals, given that we saw no growth in any of the districts in the base?
Yeah, I think they'll benefit the most from deregulation and also potential M&A activity, which I also think is a piece of this administration. And so I also, you've seen the larger banks really rally a lot more than the regional banks. So I think valuations are a bit better there. So it's just kind of a combination of all those factors.
Now, it's interesting. We come in every few weeks and we see, you know, market jitters. You know, the bond market, you know, looks like it's going to give us some trouble. And then a couple of days later, we see dip buyers emerge. In this case, it only took one day, really. We had dip buyers emerging already by the end of Tuesday. What are your customers doing?
They're dip buying, but not in the broad market sense. I'd say they're doing it much more on the single stock names. So, for example, NVIDIA was a large buy after last week. Marvell as well, which also had a not great report, or at least not well received by the market. And then you had, you know, UNH being a sell, because that was something they were dip buying previously.
Is it momentum that they're chasing? Because it does feel like NVIDIA had a lovely run up and there was some profit taking, or are they actually expecting that NVIDIA will continue to rise from here?
Yeah, I think they're seeing it as a potential continuing to rise. You've obviously seen sentiment shift in the AI space in general, right? Like a lot of questions around how effective it is, and then competition in the chip space. And I think our customer base they have a longer term time horizon, and they really like to take advantage of the shifts in volatility. And you see them, like, they hold core positions and trade around that volatility.
And also interesting, you say net buying has been increasing since June, which was quite surprising, because it would seem like, particularly when we look at some of the retailers, maybe the customer is pulling in their spending just a little bit, but they're not pulling in their speculation or their investing.
Not in our customer base. I mean, I'm really supportive of it, I would say. I think our customers are pretty savvy, and I'm supportive of it because I think in this environment, the way you're going to really build your wealth is through investing, and not necessarily from your day job. And so that's where I think, like, they really are taking advantage of the swings underlying the shift. But I think it's also, they're savvy in that you can't see the S&P 500 not necessarily moving materially higher from here, and so they're playing the volatility underneath the surface.
Can you tell, or do you have an average length of holding?
I'd say the one place we can look at is our Robinhood Investor Index, which is something that we use to track like month-over-month shifts. And I haven't seen the data yet for this past month, but what you do see is that the shift in their portfolios don't tend to change materially in terms of like the largest holdings they have. It still is NVIDIA. It still is things like Apple and Amazon. Like a lot of the Mag 7 is about 45% of the index, and that's been shifting down a little bit. Tesla's always been the biggest name there, at least for a long time, but how much they hold shifts. So it's not that they're wholeheartedly selling out of positions and coming back in later. They're really just taking advantage of the shifts.
They're titrating.
Exactly,
Yes.
which is a lot of what professional portfolio managers do.
Absolutely. I also want to ask you about Chinese tech, because you're still bullish on Chinese tech. After the news that regulators in China just may be starting to crack down, are you getting a little bit nervous about that?
I mean, obviously that's a new news report from this morning,
exactly.
so it's something I'm still ingesting. But so far, I mean, and I have to kind of do some more work, but what we've been feeling is that owning an allocation to Chinese tech has been something that's been, one, kind of hedging our allocations here in the U.S. It tends to do much better
working, right? Yeah.
It's been working more recently, and it's something that we think, like, in the tech space, if anybody's going to give the U.S. tech space a run for their money, it's going to be the Chinese tech space, and we want to make sure we have an allocation to that for that reason.
Well, I think the U.S. thinks that too, clearly. Stephanie, thank you so much for coming in to see us this morning. Wonderful to spend time with you. That is Stephanie Guild, Robinhood CIO. And later today, tune into our Bloomberg Power Players New York event. Set against the backdrop of the US Open Tennis Championship, it brings together influential voices from the business of sports. Guests include Maria Sharapova and Karl Anthony Towns of the New York Knicks. You can follow the panels on Live Go. Coming up, President Trump asks the Supreme Court to back his tariffs. More next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump is tackling courtroom hurdles, asking the Supreme Court to uphold his global tariffs after an appeals court ruled them illegal. The administration has asked the court to take up the case by September 10th. For more, I'm joined by Bloomberg Government Congress reporter Jonathan Tamari. Jonathan, September 10th is just a few days away. Is the Supreme Court acquiescing?
We haven't heard yet, although it seems highly likely that this is the kind of issue they're going to want to weigh in on. And we've seen them be very deferential to the president in his aggressive actions in the past. So it's going to be a major test for the opponents of this tariff when it reaches that stage, if it reaches that stage. But it seems likely they will want to weigh in on this.
Yeah, as Noah Feldman has just written in Bloomberg Opinion, the outcomes of the cases, there's another case, of course, as well, will have fundamental implications for the evolution of the rule of law in the United States. If the courts decide, the tariffs are legal, what precedent is that?
Well, I think it would follow a continuing trend of handing more and more power to the president and taking more and more power away from Congress. Tariffs are technically supposed to be set by Congress, but they haven't done it for decades. These are the most sweeping tariffs that any president has tried to impose using that power, and he's using a new, theory, a new law that hasn't really been used to the extent that he's using it so far. So it would just aggregate even more power to the White House, as has been happening for many years now.
Now, the courts have also found the administration's freeze on $2 billion of Harvard funding illegal. It hasn't ordered the administration to sort of unfreeze it, though. So what's next for Harvard?
Yeah, so the administration is going to appeal this. They say this ruling is incorrect. This is certainly a significant win for Harvard, but it's not a decisive win. There are definitely other levers that Trump can apply to them. So those negotiations between the White House and the school are ongoing. This might ease some of the pressure on Harvard, but it's not necessarily a final win. There's going to be more court cases on this and more negotiations as well.
And then the other massive event today, President Trump's nominee for Fed Board of Governors, Stephen Myron, facing a Senate hearing. What are you going to be watching for?
So I think that the context here has obviously changed significantly with the president attempting to fire another Fed governor, Lisa Cook. It's raised many more questions about whether his appointees will be independent. I think members of both parties are going to ask significant questions about his independence. I expect that Stephen Myron will give them answers they want to hear, but I don't know that there's much likelihood of many Republicans breaking with Trump. There's been very little evidence of that thus far during his presidency.
Yeah, and he himself has said in recent days that he is an advocate for Fed independence, so we should expect to hear something to that effect at the hearing today from him. Now, later today, Trump plans to host big tech bosses in the White House's redone Rose Garden. What do we know about what they've been planning to speak about and what we might hear?
So we haven't heard a lot about the details, but we know the administration is really pushing for additional investments in AI. This is something they want to see these big companies invest in America, create jobs in America, have this tech being housed in America. And then aside from that kind of more serious policy implication, the president just recently redid the Rose Garden, famous space in the White House, because he wants to be able to host bigger events like this. And we know he likes to play host. He likes to be around, have powerful people calling on him. And so there's both elements of that kind of his, social events and his policy focus all at the same time. He's certainly going to be looking for them to make commitments for big investments that he can announce and unveil.
For sure. We can expect a lot of news out of the administration today. Jonathan, thank you so much for joining. That is Jonathan Tamari, Congress reporter for Bloomberg Government. Staying with tech, some fresh developments in the artificial intelligence race. Apple is planning to launch its own AI-powered web search tool next year, while DeepSeek is targeting the release of its own AI agent model by the end of the year. For more, we're joined by Europe Tech anchor Tom McKenzie. So Tom, let's start with Apple. What are the details behind this new Siri tool?
Yeah, another Mark Gurman scoop on how AI and Apple is trying to catch up on the AI story. And this is a search function. It will be called World Knowledge Answers. Make of that what you will. It's going to be integrated into Siri. It may be integrated at some point into the Safari web browser and potentially into the search function on the iPhone as well. And the idea is that it will have a user experience involving videos and photos and text that will allow the user to get access to all the kind of information you get on the internet, underpinned, of course, by large language models. And here's where it gets really interesting. Apple, again, according to this reporting, has been in conversation with Anthropic. It's been in conversation with Google. It has already some form of partnership with OpenAI. And they even looked over the summer at potentially buying Perplexity and even Mistral, which is a large language model based over in France. Ultimately, they decided not to make those purchases, and it seems like at this point, Google is in the lead to provide Gemini to underpin this search service for Apple. Again, as you say, expected to be launched and released in the spring of next year.
Yeah, I mean, it's taking a while in some senses, I guess. Let's move to DeepSeek. Yeah, right? How competitive is the current AI agent landscape, and what do we know about DeepSeek's plans?
Well, DeepSeek obviously is the Chinese large language model and the chatbot maker that came out with that R1 model back in January of this year that really kind of upended the narrative around large language models, at least temporarily. Since then, DeepSeek actually hasn't come out with much of great significance. But according to our reporting, that could change in the fourth quarter of this year, to your point, with a chatbot that is agentic, meaning that it will need less human interaction. It'll be able to perform tasks for you. For example, booking a vacation. At least that is the aspiration. So clearly, it's a reminder that DeepSeek is still in the game. They could come up with a pretty significant update in the fourth quarter. It's still a company, of course, that is closely watched. And this is to some extent a catch-up story right now for DeepSeek versus the kind of platforms that OpenAI and Google are putting together with those more agentic functions.
Well, we all love watching races and, of course, iterations as well. Thank you so much, Tom McKenzie. Tom is Bloomberg Tech Europe anchor. And do tune into the next episode of Bloomberg Tech Europe. That's on September 12th. Well, staying in Europe, leaders are currently meeting in Paris with Ukraine President Zelensky to finalize discussions about security guarantees for Ukraine. The Europeans are looking to push the US to tighten sanctions against Russia. Joining us now is Bloomberg's Oliver Crook. So, Oliver, what do we know about negotiations and where things stand right now?
Yeah, so a reminder, this is this coalition of the willing arrangement that has been sort of born over the last few months that is really spearheaded by the Europeans. These Europeans that are willing to continue to support Ukraine in all of the key ways it has in order to continue fighting the war, but then also critically the day after a ceasefire, the day after peace, and trying to work out a security architecture that could potentially be backstopped by the United States, which is the latest we've heard from Donald Trump over the last couple of weeks, a sort of softening in Trump's position on Ukraine, saying that potentially they'd be willing to provide some sort of security guarantees. But you still need to flesh out what this coalition of the willing is actually willing to do. Are they willing to commit forces to Ukraine after a peace process is underway from the nations of Europe, from France, from Germany, all of these countries? In what proportion? And what is their actual function there? These are the questions that we don't yet have the answers to, and these are some of the things that will be discussed by those leaders or in those meetings right now at the Élysée Palace in Paris. We should say, though, Vani, that a sort of day after plan is only relevant if there is a day after the war, i.e. there is a peace process underway, and there has not been a great deal of indication from Vladimir Putin that he is moving in that sort of direction, which is why it's so important for all of these leaders to speak a little bit later, as they intend to in the next couple of hours, with Donald Trump to appraise what Trump's position is right now vis-a-vis Vladimir Putin. We had a little bit of light on that over the last couple of days in the press conferences that Trump has given, and some of the other administration folks have been talking about it over the last 24 hours, really saying that basically Trump's position on Putin and how happy he's going to be on Putin will sort of emerge over the next couple of weeks. We should say that all that being the case, Trump in his meeting with Vladimir Putin in the last few weeks has not diminished attacks on Ukraine, has only ramped up drone attacks, missile attacks. There are also now reports that Zelensky is saying that 100,000 Russian troops are amassing on the part of the Donbass that Russia does not yet collect. Does Trump think that that is a person that sounds like they are working towards a real peace process? That is what the Europeans are going to try to convince Trump of, the thing that they've been trying to convince him from the very beginning, that Putin is not serious and he's just playing for time.
Yeah, absolutely. A lot of fear in Kyiv. And I do want to mention that we're just now reporting that according to a person familiar who spoke in condition of anonymity, the Ukrainian president is expected to have a bilateral meeting with the U.S. Special Envoy Steve Witkoff today in Paris as well. So we'll see what emerges. Our thanks to you. That's Bloomberg's Oliver Crook there for us. Coming up, we'll get you set up for your trading day with more jobs data on deck, of course. That's next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sart in Le Mans, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, jobless claims at 8:30 a.m. Eastern before the all-important non-farm payrolls tomorrow. Then we'll get PMI data at 9:45 and at 10 a.m. Prices paid will be very important there, and of course employment. Plus, the Senate Banking Committee confirmation hearing kicks off to consider Stephen Myron to be Federal Reserve Governor. That's at 10 a.m. Washington. Now let's get to some micro movers before the market opens. Tesla says its robo-taxi app is now open to the public, and you can see that stock is up another 1.3% after a positive day yesterday. Salesforce extending its post-earnings drop in the pre-market today. It reported lackluster quarterly sales growth, disappointing investors. Broadcom, that reports after the bell today, higher ahead of quarterly earnings to the tune of 1%. So keep an eye out for Avgo just a little later on. Now let's take a look at some macro movers, because as you can see, we have the S&P 500 pointing higher, but futures markets a little bit equivocal today because we're waiting for the non-farm payrolls report and of course those extra earnings report after the close. Broadcom will be important given that we had some negative ones after the close. We are also getting news now that Revolut is offering to buy back up to 10% of its early backers' shares. That'll be an important one to watch as we approach that offering. The 30-year yield down to 487.65. It appears calm is returning to the long end, down another 2 basis points. And gold, I was going to say, is snapping its 7-day streak. So we have spot gold trading lower today, and futures there up about 0.8%. Goldman Sachs, in fact, saying it could reach 5,000 if Fed independence continues to be called into question. That's it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
This is still a tech-driven market.
Large cap U.S. market itself has been the place to be.
In general, things have been drifting more positive.
Valuations are toppy, but generally firms are performing.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, doubling down on rate cuts. Weaker economic data reinforcing the case for dropping interest rates as Fed nominee Stephen Myron is gearing up for a grilling on Capitol Hill. Investors are putting additional weight on this morning's ADP report. That jobs number very much in focus.
And my question is, how does the market respond? Is it potentially more at risk from a strong number or a weak number? Because yesterday, I'm sorry, because I'm just trying to trigger the person next to me right now, but what we saw was bad news, was good news for the market. And what we saw was a JOLTS report that came in lighter than expected, caused a rally in bonds that allowed a rally in stocks to continue. So what do you make of what that means for today's ADP report?
Data this week hasn't been great. It's been JOLTS, it's been the ISM, Beige Book too. Lisa mentioned the Beige Book yesterday. That Beige Book did not make for good reading at all for this Federal Reserve.
There's no growth, or very little growth, and pretty much that's what you could see across the board. Not only that, but it's classic stagflationary type of dynamic, the idea of prices going up. Almost all of the businesses talked about some sort of inflationary pressure from tariffs. At the same time, they're not seeing expansion opportunities. You put this together, you say, okay, rate cuts, is that enough to juice demand and juice the animal spirits to come back? And that, I think, is what markets are grappling with.
So Stephen Myron goes to Capitol Hill, confronting some of these issues, no doubt looking for lower interest rates. He's got this to say: the FOMC is an independent group with a monumental task, and I intend to preserve that independence.
This is going to be his entire shtick today. Federal independence. He wants to be there to preserve it. He's going to make that point crystal clear. It's going to be very hot rhetoric when it comes to Washington, when it comes to Steve Myron, when it comes to the Democrats. They have made it very clear that they are going to go after him and basically make this a referendum on the Trump administration, what they say has a heavy hand when it comes to Fed independence. But this is an individual that was just confirmed in March, party line by Republicans. There is no question that Steve Myron will be confirmed. The question going in today is the timeline. Will he be there for September 16th?
Can he make a credible argument for lower interest rates without being accused of being a puppet? Now, who does he need to convince? It's not the senator from Massachusetts. He needs to convince the market that this is a credible pick for an independent institution. Forget the political noise in the room. It's about the market response to this pick that matters.
Which is the reason why markets will be watching this hearing. And right now, it doesn't seem like it matters to a lot of the Republican senators who will probably confirm him. To your point, Anne-Marie, he will be confirmed. What's his definition, though, of independence? Remember, he wrote a paper last year. He co-authored a paper saying that the Fed could preserve its independence by allowing the president to more easily replace him with a Fed member. So the definition of independence very much on the table.
Also, an open question is whether or not he will keep his seat at CEA. Can he even do that? Or when the term is up at the Fed, will he go back to the CEA? Speaking of that paper, he wrote with Dan Katz, who's the chief of staff of the Treasury Secretary. They talked about the revolving door in Washington between the Fed and the executive branch. Well, he would basically be part of that revolving door. Then in this paper, he argues there should be a four-year window.
It could do both, can't he? How many jobs has Rubio got right now? Just sort of tally them up.
At least three. At least
Right.
three.
And he could build homes.
Yeah, exactly. Last week at the cabinet meeting, it was Marco Rubio. He said, I'm really going to be enjoying this Labor Day because I have more jobs than I've ever had.
If you are just tuning in, welcome to the program. Equities right now positive by 0.2% on the S&P 500. Busy morning coming up. This hour we'll catch up with Stuart Kaiser of Citi. With stocks looking to add weight to the recent rebound, we'll speak to David Wilcox of the Peterson Institute as President Trump's pick for the Fed heads to Capitol Hill, and Mike Powell of BlackRock on the loss of macro anchors. We begin this hour with stock steady as investors await the latest read on the US labour market. Stuart Kaiser of Citi writes the following: the bar is fairly high for investors to move into lower quality stocks given economic uncertainty. Stu joins us now for more. Stu, good morning.
Good morning, how are you?
Typically, I wouldn't be teasing ADP, but this morning I'm teasing ADP. How important is that data point now?
I mean, markets don't react too much to ADP, but, just given the overall messaging going on, I mean, claims more important than ADP, but probably both important. You've kind of had a string of, not bad economic data, but I guess I would call it kind of questionable economic data. There'll be a focus on it, but again, it's kind of second-tier labor market data, I would say.
First tier tomorrow.
Yes.
Are you expecting strength or weakness?
I mean, consensus is 75K. Our economists are 45. So, the house view is a little bit to the weaker side. 45 or 40K are probably the bare minimum equity markets are willing to accept. I think anything below that, you'll probably get a bit of a pullback. But, tomorrow, I think, to Lisa's point, is all about rate cut expectations. And tomorrow can maybe get you to pricing more than a full cut. I don't think it can get you to pricing less than a full cut. I mean, you would need just an absolute blowout number to the upside. And given the recent momentum of the labor market data, it's going to be very hard to get you sort of sub a full cut. If you printed really weak, you probably get, a cut and a half price or something like that.
I was trying to trigger you earlier. Did I succeed?
You were trying to trigger Emery,
No, I was
actually.
trying to trigger you because ultimately you've always said good news is good news and bad news is bad news. And what your call is essentially reiterating that. Don't go down in quality unless you believe that the economy is really going to kick off. But isn't what we saw yesterday in terms of the response to the JOLTS data an indication that bad news could be good news in terms of spurring rate cuts and allowing the market to really get those animal spirits underfoot?
I mean, like the very tactical reaction to that might be positive, but big picture, if the labor market is slowing considerably and the Fed feels kind of behind the curve, then that's negative for equity markets because it's very hard, to your point, for them to cut enough to kind of, rescue the economy or bail the economy out quickly. So, we're still in if you get a bad labor market report, that's negative for U.S. equity markets. And you also use the word stagflation, and I wouldn't consider stagflation to be good.
Well, okay, maybe not now, but if there is a feeling of growth that's juiced by a Fed that might not be responding exactly and only to the economic data, but also to political pressure, does that unleash something new for you that might be positive, at least in the short term for stocks, albeit potentially really negative in the long term for bonds?
I mean, look, again, if the Fed is cutting for any reason that is, A, they're being forced to, i.e. policy is not consistent with their dual mandate, that's negative. And if they're cutting because labor markets are weak, I think that's negative. A little bit of what you got yesterday, too, I think was not all related to the data in the U.S. Foreign bond yields kind of stabilized in the U.K. That allowed U.S. yields to kind of stabilize as well. So I think you got a little bit of that reverse spillover, however you want to think about that. So it was a little, my view is it wasn't that much about the data because I don't really think you saw a meaningful change in the pricing of September cuts anyway on the JOLTS data. I mean, 2-year yields were down, about 4 basis points. So there's something there. If you want to talk yourself into a bullish story, but again, the real bullish story here is that economic growth is you print 125K jobs, and the beige book surveys start to skew a little more positive, and you actually have like a real growth impulse. If you're printing negative jobs data, an extra 25 basis points isn't going to help the market, I don't think.
When it comes to the data, you call tomorrow's data first tier. Is it put into question, though, given the fact that the President of the United States basically says he doesn't believe the BLS numbers anymore and wants to putting a new commissioner at the top of the institution?
Well, and that's why September 9th is important. I think September 9th you get BLS revisions, and it's going to be very interesting to see what they do there and how President Trump reacts. I mean, the market has to react to the data that's in front of them. Some might argue that ADP is cleaner than BLS data because that's actual, people on ADP payrolls.
But is that why ADP has taken on this new importance, because of the political overhang on the BLS?
I think that's part of it. And also, like the last year or so, ADP is typically printed a little bit weaker than BLS jobs data, and then you've had large negative revisions to BLS jobs data in the future. So it actually looks like ADP, it almost looks like the BLS data has kind of converged to ADP. So that's probably helped it as well. I also think you're in a market that right now is much more comfortable with quote unquote alternative or new sources of data. And I don't know if I'd call ADP that, but it's a little more in that direction.
You alluded to it. We've been talking about it around the table. The sneaky bull case. What is the sneaky bull case going into year end?
I like the sneaky bull case to me is corporate America kind of, went on siesta for 3 months as we dealt with tax, tariff, and immigration uncertainty. And, as you may know with budgets, if you have a 2025 budget, it needs to be spent in 2025. So that would be your bull case, I think, is corporate America says, all right, we have the tax and spending bill passed. We have a little bit more clarity on tariffs, and hopefully the immigration uncertainty is a little bit lower, and that allows a little bit of a spending and hiring, kind of upside. We'll see. Obviously, if you look at, earnings were pretty decent. If you look at going into the earnings season, consensus was like mid-teens, Mag 7 earnings growth. We got mid-20s. Consensus is at about 2.5%. S&P 493 earnings growth, we got like 8%. So there is, an earnings story there. Earnings guidance was very positive. 40% of companies guided positive. So if you're willing to squint and take a leap of faith here, there are some positive trends on the corporate side of things. And to me, that is the big bull case. You get a little bit what you got last summer, which is a 3-month slowdown followed by a 6-month rebound.
A lot of business owners are thinking about that sneaky bull case. And I was speaking to one yesterday who was saying that actually if there's a 50 basis point rate cut or 225 basis point rate cuts, that could be enough to really start to unleash some of this activity. What do you think would be required in terms of the landscape for that sneaky bull case to come to fruition?
Honestly, I think almost like a base case on the economy might be a bull case for corporate America, i.e., we're slowing down but not going into recession. You get a couple quote-unquote insurance cuts behind that, and inflation is sort of sideways. I think if you got all of that together, corporate America is going to say, okay, I have a little more policy uncertainty. I'm not in a recessionary economy, and they were willing to give me 50 basis points of cuts at year end, and maybe that makes me more confident to do my investing. Like if you look at the small business surveys, optimism spiked after the election, and then uncertainty spiked after the election, and both of them kind of got to near 50-year highs, call it. So you're in a situation where businesses wanted to be optimistic, but they were super uncertain about the outlook. What's going to win, I guess, is the question there, right? Now, if you get uncertainty down, the optimism wins. If uncertainty stays where it is, that's probably going to win out. So a little bit of a balancing act there between I'm excited, but I'm scared.
What you described sounds a lot like what we saw play out last year. Had a labour market head fake through the summer. Fed comes out, gets nervous, drops rates 100 basis points. The question this time is whether this is really a labour market head fake or the real deal, because the data that keeps coming in keeps supporting that it might be the real deal.
It's frustrating to tread water for 3 years. And that's sort of what people have been saying for a long time. Wait for the breakout. And ultimately, the breakout hasn't happened economically. It has happened from a stock market perspective. And this is just adding to the tension that people feel. It's sort of this pent-up demand to be optimistic because we're Americans. But on the flip side, this question of uncertainty that just dampens it down. And that treading water, it's exhausting.
There has been a cyclical tilt to this equity market in the last month or so. This market is positioning for a pickup in economic growth. We're waiting for confirmation. Will we get it this coming Friday?
And will 25 or 50 basis point of rate cuts give that sort of animal spirits to that cyclical aspect of the market? That ultimately is what a lot of people are betting.
I'm long the economy. I hope you're right. Stuart, it's good to see you.
Good to see you.
Stuart Kaiser of Citi. Thank you, sir. Equity's doing nicely, up about 0.2% on the S&P 500 with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Tech industry leaders are heading to the White House today. CEOs from Meta, Apple, Microsoft, Google, and more are all expected to attend an AI event hosted by First Lady Melania Trump. It will be followed by an evening reception with President Trump in the newly renovated Rose Garden, which you can see there. Meanwhile, Salesforce shares are falling more than 6% in the pre-market after the software company issued weak revenue guidance, suggesting its AI product isn't yet paying off as quickly as hoped. But CEO Mark Benioff remaining optimistic, telling analysts on the call, this is just the beginning of the most transformative time in our industry. And sticking with tech, Apple is gearing up to launch its own AI-powered search tool next year as it tries to compete with OpenAI. Sources telling us here at Bloomberg it will be built right into Siri and eventually its Safari web browser, and some of the underlying technology could even come from Google. Apple is targeting a spring release, part of its long-awaited Siri overhaul. That's your Bloomberg Brief. John?
Yahara, thank you. The name's questionable, isn't it? What do you make of that?
World knowledge answers. It's like World Wide Web. I'm one of the kids. Look at me.
I'm guessing that's just an internal name for it, right?
I hope it is, because right now it's being blasted. I'm sorry, it doesn't roll off the tongue.
Sure.
WKA.
Yeah.
It's not cool.
We'll come back to that later in the program.
Maybe.
Up next on the show, Trump's Fed pick facing a grilling on Capitol Hill.
He would like to see Stephen, who I've known for a long time, get on there as soon as possible. Putting Stephen Myron in, that gives us more time.
Up next on the program, we'll catch up with David Wilcox of the Peterson Institute, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Snapping a two-day slide on the S&P 500 in yesterday's session this morning, adding some weight to the bounce back, up 0.25% on the S&P, up 1/3 on the Nasdaq 100. Under surveillance this morning, Trump's Fed pick facing a grilling on Capitol Hill.
The president has great sway with Leader Thune. Leader Thune's been a great partner during the tax deal, and I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. Putting Stephen Myron in, that gives us more time. And again, I want to cast a wide net. The president's very open-minded.
So here's the latest this morning. The Senate holding an accelerated confirmation hearing this morning on Stephen Myron's appointment to Federal Reserve Governor. Myron saying in prepared remarks that he intends to preserve the independence of the institution. Joining us now in Washington, D.C. is Bloomberg's Tyler Kendall. Good morning, Tyler.
Hey, John. Good morning. Well, you said it there. We're expecting Stephen Myron's nomination to proceed on perhaps an expedited schedule with this first step today, his hearing in front of the Senate Banking Committee. And while the spotlight will be on Myron, this is also giving us a rare glimpse into how Senate Republicans are balancing their past calls for Fed independence with their current support of President Trump and what many of them have said is his right to voice his opinion when it comes to monetary policy. Now, Stephen Myron's going to have to make a credible case to lawmakers that he's the man for the job, and we sort of got some insights into how he's going to frame his messaging. In prepared remarks that he's expected to read at the top of the hearing, he says that he will preserve the Fed's independence. You read one of the quotes there, but I'll highlight another. He said that independent monetary policy is critical for its success. But the thing is, Myron has previously called for greater presidential control when it comes to monetary policy. In a paper written last year, I know you spoke about it at the top of the show, he advocated for some perhaps more controversial changes, including shortening the terms of Federal Reserve governors and also subjecting the central bank to the congressional budget appropriations process, something that just isn't done. Now, for context here, Myron was confirmed to his current post in a 53-46 vote earlier this year. That means that 4 Republicans would have to vote against him in order to sink his nomination. And at this point, that doesn't seem likely. And Democrats can see to us privately that they realize that there's not a lot of procedural moves that they can take that would delay this vote until after that September meeting. Now, John, I did catch up with a senior Democratic aide to Senate banking leadership yesterday, and they pointed out that there are other nominees that are going to be at this hearing, but they told me to expect every Democratic member to gear their questions towards Myron exclusively.
Tyler Kendall with the latest. More from Tyler in the next hour. Tyler, thank you. Joining us now to extend the conversation, David Wilcox, the Senior Fellow at the Peterson Institute for International Economics. David, welcome to the program, sir. If you had the opportunity, if you're in that room today, what would be your first question for Stephen Myron?
My first question would be, gee, it's interesting that you're marketing yourself as an advocate of Federal Reserve independence, given, as Tyler just mentioned, that your paper is chock full of ideas for how to undo the guardrails that currently protect the Fed from day-to-day political fray.
There's also, David, in that paper, some ideas from Steve Myron and Dan Katz that would actually make the Fed potentially, some would argue, more independent. This idea of short-circuiting what he calls the revolving door between the Fed and the executive branch, which we've seen under Democratic administrations like the Biden administration when it comes to Janet Yellen and Lael Brainard. So can't you make the argument that actually he has ideas that do fortify Fed independence as well?
I think that's a tough argument to make. The reason why is because he would make not only board members in D.C., but also Reserve Bank presidents scattered around the country, subject to being fired at will by the President of the United States. And he and his co-author, Dan Katz, go so far as to admit that the likelihood is that when a new president came into office, they would probably clean house and start with a full new slate of Federal Reserve policy leaders. That would introduce an element of discontinuity into monetary policy that we just haven't seen. The tradition at the Fed has been much more for continuity, nonpartisan analysis of monetary policy and the longer-term economic interest of the country.
Since many think he's going to be confirmed, given the fact that he was confirmed on party line votes just months ago, what are you going to be looking out for today when it comes to this hearing?
Well, I'll be interested to hear what he has to say about whether he stands by these institutional changes that he would make to the Federal Reserve. He won't have a lot of leverage in that regard because that would take an act of Congress. I'll also be interested to hear how he will balance the dual concerns of the Federal Reserve. On the one hand, maximum employment, and on the other, price stability. Another area for inquiry, it seems to me, with senators is Myron's repeated statements that there's no evidence of any pass-through whatsoever of tariffs into consumer prices. That's got to strike the ears of senators as a little peculiar. I'm sure they're hearing from constituents that selected imported items are experiencing marked price increases.
Do you think, David, that it matters if Stephen Myron is confirmed, considering that he's only going to be there for a couple of months and he's only one voice?
He's a placeholder. It will be an important voice. It'll be a bellwether of where the administration stands. It takes President Trump one step closer, though, to having a tipping point in terms of control over the Federal Reserve governance structure as a whole. With 4 members of the Federal Reserve Board, he will be able to, if all 4 are willing participants, he'll be able to radically change the decision-making of the Federal Reserve. Myron would be number 3, but this is why the struggle over Lisa Cook is so hugely consequential, because if President Trump can succeed in ousting Cook, that would be number 4. And I should mention, by the way, yes, I am affiliated with the Peterson Institute, but I'm also a colleague of yours at Bloomberg Economics.
Thank you, David, for that. I'm wondering if we're looking at this the wrong way. If you take a step back, I wonder if the independence of the Federal Reserve has been inherently compromised by how much debt the United States has incurred, and the fact that the Federal Reserve sets interest rates at a time where the maturity profile of that debt is getting increasingly short-term. In other words, they have more control over how much interest the United States pays. Isn't that inherently going to be political going forward, regardless of who is the president?
I don't buy it. What we learned from Paul Volcker in the 1970s and early 1980s is that a determined, focused central bank can exercise the tools of monetary policy operating in the environment that it finds itself in. Volcker was dealt a very difficult hand. He came in a time of raging inflation, huge oil price shocks. His predecessor by 2, Arthur Burns, had pleaded he was powerless. He couldn't change the situation. Volcker came in determined to prove Burns wrong, and that's exactly what he did. It seems to me that this current situation with a lot of debt, with fiscal policy undeniably on an unsustainable trajectory, is somewhat similar. That complicates the environment for the Federal Reserve. It doesn't absolve them of their responsibilities to deliver good inflation performance and maximum employment.
David, appreciate your time, as always, and hopefully we can follow up after this hearing. David Wilcott's there of the Peterson Institute and, of course, of Bloomberg Economics. Have we seen evidence of a de-anchoring of inflation expectations? I would keep going back to that. Yes, there are reasons to be concerned, absolutely, but has any of this contributed to a de-anchoring of inflation expectations?
So far, no. And you could say that based on break-even rates. You can also say that on the fact that inflation expectations over the longer term have actually come in over the past 6 months. However, there are an increasing number of analysts saying that this is an increasing risk. And that's the reason why Goldman Sachs sees gold potentially going to almost $5,000 by the middle of next year if there is a real de-anchoring of that. So it's still a threat, but it's not getting priced in any meaningful way.
I'm not understating the risk here whatsoever, but I think just taking the temperature of things right now in markets, things aren't boiling over in quite the same way as they are in the world of economics.
And a lot of the belief here is that the markets will act as the ultimate check. They're the adult in the room.
Absolutely.
And essentially, if there is a nominee who is going to act in a way that would on more inflation expectations, you'd see that response, and then there'd be a response to the response, and that's, I think, what a lot of people are betting on.
We'll get to that gold call in just a moment from Goldman Sachs. Coming up on the program, we'll also speak to Brooke Roach of Goldman Sachs from the Goldman Annual Retailing Conference on the state of the consumer. Plus, Danny Berger with your morning movers, with Hewlett-Packard shares rising on earnings and revenue beats.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The bounce continues, positive by 0.16% on the S&P 500 after snapping a two-day slide in yesterday's session. Up again on the Nasdaq by 0.24. In the bond market, 2-year, 10-year and 30-year. 2-year bond yields near the lows of the year, down 2 basis points this morning at 359.60. In yesterday's session, a double-digit range on a 30-year bond yield, getting close to 5%, then backing away. 487.45 this morning, down another 2 basis points. And Lisa, you said it. The tension eased off the back of weaker than expected data in yesterday's session.
We saw bond yields swing in a range that we haven't seen since the payrolls report at the beginning of August, just on the heels of the job openings report. And yes, job openings fell to the lowest pace going back to September of 2024, but it highlights how attenuated this market is to any kind of weakness that would unleash that type of Fed easing that people are expecting.
Things settling down so far this morning in the bond market. Let's turn to gold. Bramo mentioned it. 7-day move on gold coming into Thursday. Longest winning streak of the year so far. Just a little bit softer this morning, but still up on the year by about 35%. Goldman Sachs talking up the possibility of 5K on gold next year with this simple line from Samantha Dowd at Goldman. Gold is a store of value that doesn't rely on institutional trust.
And they are saying that it could reach almost $5,000 by the middle of next year if just 1% of current privately owned U.S. Treasury holdings were to migrate away from that asset class and into gold. A lot of people considering this as you see central banks around the world increasingly doing exactly that. It's fair to remember before you say, wow, they really have something to sell. It's fair to remember that gold has doubled in price since the end of 2022. Doubled, more than doubled.
Yep.
So it gives you a sense of how much scope there was to run and maybe what's to come.
And a move continued through 2025 so far. Just a little bit lighter, softer this morning. We're down by 0.5%. With 3 hours to go until the opening bell, let's get you some morning movers. Let's cross over to Danny for more. Hey, Danny.
Hey, John. Some tech earnings after the bell yesterday to get through. Let's start with the good, and that was HPE, Hewlett-Packard Enterprise, reporting earnings that beat on most metrics. But the real concern for them had been margins, considering that they were thinning out. But HPE, the CEO, coming out and saying, with AI-driven demand, we are weathering the margin slim down. We're going to go from something like 6.4% to 10%. Meanwhile, some of the more ugly tech earnings, among them Salesforce, those shares down 6.6% in the pre-market this morning. The company giving a lackluster outlook for growth. The concern for them is that they haven't had as many customers take up their AI products as had been hoped, or the more emerging AI market players being the ones that are upsetting them. Can they really capture that audience? Meanwhile, we also had earnings from Figma, their first set of earnings since going public. Shares down a whopping 14.5%. Let's just remember where the bar is. This is a company, a software design company that's doubled since its IPO. So investors were expecting a lot. It gave a forecast that was in line for expectations. This is what in line gets you, a big decline, John.
Danny, thank you. Down almost 15%. You want a big mover? American Eagle in the pre-market. What a move. Up by 24%. in early trading.
Thank you, Sydney Sweeney. Evidently, that really had some legs, and they saw their shares skyrocket. They had better than expected earnings, and it seems like no controversy is bad controversy when it comes to retailers.
The timing with Travis Kelce as well.
Oh, yes.
They timed that perfectly.
Oh,
what a coincidence.
You're a conspiracy theorist.
What a coincidence.
Oh, is that right? Would you like to share your thoughts?
Absolutely not.
All right, then, let's move on.
Stock is up in the pre-market by 24%. On our radar this morning, President Donald Trump asking the Supreme Court to uphold his global tariffs after an appeals court found them illegal. Trump asking the court to take up the case on a highly expedited schedule with arguments by early November.
So if you look at the submission to the Supreme Court, basically the administration is saying it's too big to unwind, it's too important to unwind. They say it eviscerates a critical tool for addressing these emergencies, for these negotiations with trading partners. And this is what was interesting. The Treasury Secretary in this ruling, in this submission to the Supreme Court, is talking about how it's already impacting ongoing negotiations. Quote, world leaders are questioning the president's authority to impose tariffs, walking away from or delaying negotiations, and or imposing a different calculus to the negotiating positions. So at this moment, even though the market is waiting for a final decision, what you're hearing from the administration is that it's adversely affecting their negotiating process with all of these countries, namely like India, that are still trying to get to a trade deal.
I want to know about the money, how much money they're counting on to come in from the tariffs, what it means for them to have to give back tens of billions of dollars. That's what I want to hear in these discussions.
Tens, try hundreds potentially.
Hundreds of billions of dollars.
Yeah.
I mean, they said the CBO estimates that there's going to be $3.3 trillion of tariff-related revenues from 2025 to 2035 if, and this is a pretty big if, they stay on at the current rates.
And can you imagine unwinding all of that money? Also, interesting to note, when it looks at what is going on in terms of if you have to unwind it, estimates from the Tax Foundation said tariffs are at risk in the case to account for about 70% of projected tariff revenue in 2026. So what does this mean for those individuals who are actually looking at tariffs as good in terms of bringing down these deficit concerns? All of that can be unwound at the Supreme Court.
That's an ongoing story in the nation's capital. This is going to be front and center later this morning. President Trump's pick for Fed Governor Stephen Miron heading to Capitol Hill for his confirmation hearing later on. Miron saying he intends to preserve the independence of the Federal Reserve. Elsewhere, a congressional stock trading ban gaining momentum after a bipartisan group of House lawmakers agreed on a new bill. The bill's supporters spanning the political spectrum from Chip Roy of Texas to Alexandra Ocasio-Cortez of New York. Can we finally make this happen?
I think it's going to happen. The issue, of course, is that you have to have leadership put on the floor for a vote. You have individuals like Congresswoman Anna Paulina Luna saying, I'm going to force a vote on this measure if the GOP leadership does not put it to the floor. We should note, this is for senators, this is for congressmen and women. This does not go to the executive branch, which a lot of people are speculating this is because the president wouldn't want to sign something that goes to the executive branch. But Jonathan, everyone is going to point to what is going on with some of these congresspeople. How many examples do we need to have to see that? Do you see individuals in Congress taking advantage of what is going on, that they have what some would call inside information, and then executing?
So much doubt. Maybe they're just phenomenal traders. I've asked that a few times. Perhaps Nancy Pelosi is just a phenomenal trader.
And her husband, too. I think
phenomenal.
So. I think
also Marjorie Taylor Greene. Marjorie Taylor Greene as well.
You're going to go with
People have got their doubts about that.
Yeah, they can go to, Wall Street.
That's the latest on Washington, D.C. Let's turn to the economy and to retailers. Macy's surging 20% in Wednesday's trading following an upbeat forecast on the consumer. The retail team at Goldman Sachs writing, quote, while there continues to be concerns around spending behavior, we remain cautiously optimistic going into 2026. Joining us now from the Goldman Sachs Global Retailing Conference is Goldman's lead apparel analyst, Brooke Roach. Brooke, welcome to the program. Let's just talk about this. So, the retailers are talking up a better story. The economic data is not so great at the moment. What's the call from you and the team?
Good morning, and thank you. It's great to be with you this morning from the Goldman Sachs Global Retailing Conference. This is our 32nd annual conference, and we're with nearly 80 companies talking about strategy and what's happening in the state of retail. Bottom line is that the consumer remains resilient.
This is what we're hearing from a lot of different companies. And yesterday I was there and I was speaking with one CEO who said it's sort of like a flat surface, a hard surface. Under the hood, there's a lot going on and a lot of molecules that are kind of battling each other, but it all comes together to kind of a flat surface. What are people looking at that could potentially break it to the upside, this sort of stealthy bull case that we keep hearing about?
That's a very good question. I think overall, as we put together all of the various inputs of what might be driving consumer discretionary demand on a go-forward basis, we see a better outlook into 2026, with discretionary cash flow modestly stronger across income quintiles, and with some real opportunities for consumers to engage with great product and great retailers. What we're seeing overall is that trends have been better throughout the back-to-school season, and this strong back-to-school season start is much better than expected. And I think there is a view from many retailers that there is some cautious optimism that hopefully this will continue. But I think retailers are very cognizant that there is a tougher comp ahead and that there is some uncertainty on what the pricing backdrop might mean and what that might mean for consumer engagement from a demand perspective. The good news is that we haven't yet seen price elasticity of demand, and back to school has been strong. So what could break it? I think there's a lot of questions on what could be the case for consumers in terms of their mood or what might be happening, but we believe that the outlook is fairly robust.
What you just said there is actually really important, the idea that a lot of these retailers are increasing prices and people are still buying. In other words, they still have the power to increase prices and it's not destructing demand. And you're seeing that pretty much across the board. They're able to raise prices in select ways. Do they have a sense of whether this is coming from wealthy individuals, whether this is coming particularly from more luxury sectors, or whether this is across the board through all the tiers of different income levels?
I think at this point, retailers are trying to do their best to protect the consumer and to protect their businesses, but they are seeing some cost increases overall. At this juncture, we've only seen modest price increases across the board based on what retailers are telling us, but there is some question about what that price might look like into the back half of the year. As we think about that, the change so far, given that it has been modest and it hasn't been broad-based across the board, as far as what retailers are saying right now, consumers have been able to absorb these price increases. They do have higher discretionary cash flow in their, they do have a stronger wallet right now. And so far, it does appear that many retailers are looking to try to do it in a way that won't hurt the consumer, whether that is a mix shift into different types of products or categories or otherwise.
Brooke, before you go, can we lend some thought to the idea that maybe the C-suite, I think, is struggling with this cultural moment in America as well? I'd love your thoughts on this and what you're hearing from management teams. I'm thinking more recently of Cracker Barrel almost blowing itself up, American Eagle leaning into controversy, and it benefits them. The stock is up nicely in the pre-market so far this morning. What's your understanding of how the C-suite is wrestling with this moment?
You know, I don't know about your specific examples that you gave, but what I would say is that retailers are focused on engaging with their core consumer. They're investing more in marketing. They're looking to try and create better products that will drive strong consumer demand regardless of what the macro backdrop looks like. And we're seeing more and more retailers lean into that. And we heard that a lot yesterday with various comments about marketing, consumer engagement, and great new product.
Brooke Roach of Goldman Sachs. Brooke, appreciate it. Thank you. Two well-known examples in the last few weeks.
Yeah, and actually, some of the corporate executives at that conference were talking about things like the more androgynous look is now moving to the very gendered look of boys sections and girls sections, and how that's a very different kind of trend than it was, say, 2 years ago. And that's one way to sort of revive some of the brands. So you're definitely hearing a sort of change in tone as there is a recognition of some of this.
Also, they're moving into Americana. They're trying to make that cool again. I thought this stat from American Eagle was insane. The company chief marketing officer said they gained new shoppers in, quote, every single county in the United States. American Eagle was not that cool 6 months ago. It is very cool right now if you have a teenager or a tween in your household.
You're catching up with the Gap boss a little bit later this morning, right?
Yeah.
Richard Dixon.
Yeah, I'll ask him about that, exactly what he's seeing with that. I also am curious about how they're managing some of the uncertainty and what it would take for them to unleash some of the animal spirits. One thing that you can see in some of the data is that sales have only increased in the actual numbers because of inflation. Otherwise, they've been kind of flat. How do you turn it around? How do you get that cool factor at a time where margins potentially are really cramped?
Such an interesting moment for this sector. We'll catch up with Richard Dixon, the Gap CEO, 10:30. Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. ConocoPhillips has announced plans to cut 20 to 25% of its roughly 13,000 strong workforce. The majority of the reductions will occur this year and will include employees and contractors. According to Reuters, ConocoPhillips will hold a town hall meeting today. Meanwhile, Newsmax is suing Fox News for allegedly maintaining a monopoly for U.S. right-leaning pay TV news. Newsmax says Fox coerces distributors to unfair terms that prevent them from carrying its competitors. In response to the lawsuit, a Fox spokesperson said Newsmax cannot sue their way out of their own, quote, competitive failures. And DeepSeek is developing an AI model with more advanced features to compete with OpenAI. Sources telling us here at Bloomberg the model is designed to carry out multi-step actions on a person's behalf with minimal direction. DeepSeek's founder is pushing to unveil the model in the final quarter of this year. That's your Bloomberg Brief. John?
Want to watch there. Yahira, thank you. More from Yahira in the next hour. Up next on the program, traders hedging their bets.
Uncertainty continues to rule the day. Kind of the range of volatility on the bond side at least has consolidated much less than where we were. We're just hedging our bets.
A conversation up next with Mike Powell of BlackRock, live from New York City. You're watching Bloomberg TV.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Willow Bay. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Later on this morning, we don't usually talk about this, the ADP report. Teasing and promoting the ADP report. The estimate in our survey, 68K. That's a downshift from the previous month of 104. And investors seemingly putting additional weight on this print later this morning.
Well, if there's a little bit of a shine away from the gold standard, which is the Bureau of Labor Statistics report that comes out tomorrow, well, where are you going to turn? And that is ADP. And suddenly, they're looking pretty.
Going into that, equity futures positive by 0.2% on the S&P 500, on the NASDAQ up by 0.3. Out of surveillance this morning, traders hedging their bets.
Bond investors are a little concerned about putting on too much of a steepener trade. We're just hedging our bets, as with everything. Uncertainty continues to rule the day. Kind of the range of volatility on the bond side, at least, has consolidated much less than where we were a year ago, 2 years ago, 6 months ago.
So here's the latest this morning. Some investors hedging their bets on treasuries ahead of a string of labour market data this week. Mike Powell, the deputy head of BlackRock's portfolio management group, writing the following. The loss of long-term macro anchors that have underpinned long-term asset allocation defines this new regime. Macro risk matters more now. Mike joins us now for more. Mike, good morning.
Morning.
It's good to see you. Let's go through this because I know you and the team have given this a tremendous amount of thought. What has changed? What is this new regime? And what do we need to manage now that we could ignore before?
Yeah, so I'd say, historically, what's mattered most of all, it's the growth impulse, it's the inflation impulse, it's a predictable policy framework around monetary and fiscal policy. A lot of those kind of core steady attributes of the macro environment are in historic uncertainty, and what's come in their place? Well, geopolitical uncertainty, trade uncertainty, a massive technology impulse that's really defining the landscape. It means that macro matters more than ever, cannot be ignored, and at the same time, macro forecasting is a much different endeavor than it has been over the past few decades.
So what are you and the team advocating for? What are you suggesting should be the approach now versus what the approach was in the last decade or so?
Lisa, you were just talking about the role of gold in portfolios and how important that is. I think what that highlights is investors are searching for alternative forms of diversification, and that's what we're really talking about as well. BlackRock published a piece just last week about the role of hedge funds in portfolios, and that's really about the same theme. Like, how do we identify alternative sources of diversification in this new macro environment? And I think the thesis of that piece is, there are two ways of doing it, but you can't ignore macro in either case. One, you've got to dial down the macro risk in your portfolio and really seek uncorrelated sources of return away from the macro. Or two, you need to embrace the macro and really consciously manage that. And hedge funds provide the levers to do that.
Is gold replacing treasuries as that allocation?
Well, I think that's a really great question. And like I said, I think the important thing is the theme that investors are searching for alternative forms of diversification. Some are finding it through gold. I think there are other ways as well. And like I said, we think uncorrelated hedge fund strategies, whether they're dialing down macro risk or leaning into it, that's the way of finding that kind of diversification.
Earlier in the show, John was saying that market expectations for inflation have not gotten unmoored. And that has been sort of one bedrock that a lot of people have clung to say that the Fed's independence has not yet been fully compromised. What do you make of that? Do you think that this market is overly complacent about the risk of inflation really picking up or being increasingly volatile on the heels of a Fed that is facing a much more politically difficult moment given the fiscal deficit and given the fact that more of it's going to be in the short term of the maturity profile?
So I'd say a couple things. I think one, I think there's some encouraging news in the inflation data itself. So I think to your point, looking out over the long term, those expectations have remained well anchored. I think, I was reading some work that Jason Furman did at the end of last week and talking about the ways we look at core PCE and look at the kind of market-based prices in that index, you see some pretty encouraging trends there. And in particular, once you strip away the tariffs, things look sort of relatively positives. I think to your point, we've heard from the Treasury Secretary, central bank independence matters. It's precious. It needs to be preserved. I think that's something that we at BlackRock believe as well. I think one of the things we would say is when you look at the risks around a rising term premium, the fiscal picture, risks around sticky inflation, but also the need to preserve central bank credibility are all things that need to be managed if we're going to hold term premiums to a reasonable place and hold yields in that reasonable place as well.
Mike, when it comes to macro risk and geopolitical risk, you're almost a perfect individual to have insight both Wall Street and Washington. I'd love to get your sense on how you're viewing some of these trade negotiations that the administration hasn't gotten to a finish line, notably India, because you spent a ton of time there.
So, I think the administration, with respect to some of these issues, faces tough trade-offs. So on one hand, clearly, they have been looking to increase pressure on Russia. The most important way of doing that is increasing pressure on Russian energy exports. On the other hand, it's been a bipartisan priority for 25 plus years to enhance the U.S.-India relationship. And I think, balancing those two things has proven to be a challenging kind of path to navigate. I'd say what I worry about is that we're landing in a place potentially where we're not getting meaningfully more pressure on Russia, but we are seeing a deterioration of the U.S.-India relationship and a deterioration that is increasingly having impacts on U.S. firms that have pursued China +1 type strategies and now see that under pressure.
Yeah, Apple being one of them. That's for sure, who find themselves in India now with a production base with some exemptions. We've talked about this a million times. This is the problem, I think, for corporate America right now. They don't know how to price this moment. I'm not sure investors do either. You talk about tough trade-offs. Lisa touched on an important question. I just want to pin you down on it. When you talk about things like hedge funds and maybe increasing allocations to alternatives, how are you funding that? What are you telling people to do?
Yeah, so I think exactly to the point around upward pressure on term premiums. I think our view is government bonds are going to have a less important role to play in portfolios as diversifiers looking ahead. And so diversification alternatives like hedge funds, like gold, have to get a hard look from investors, but it's really that fixed income allocation that I think has got to be the point of focus.
What would you have to see when it comes to the Stephen Myron hearings or anything that would happen on the Federal Reserve that would make you say, actually, now is the time for you to have to shed U.S. Treasuries or U.S. government debt that much faster and move to these alternatives, that term premium has to go that much greater to a that much greater of a degree?
So I wouldn't want to speculate on kind of future conditions. I think the fact is investors need to make decisions now. And I think our view is, there is going to be likely upward pressure on term premium from here for all the reasons I cited. That means that government bonds, whether in the U.S. or frankly elsewhere in the world globally, are going to be less effective diversifiers, and the need to navigate that risk, navigate macro risk by alternative sources of diversification is the here and now issue, not 2 years from now issue.
Mike Powell of BlackRock. Really thoughtful stuff. Appreciate your time, buddy. It's good to see you.
Good to see you.
Thank you. Talking about a new risk, a different regime, and for that reason, you need a different diversifier. And bonds don't get it done anymore. And we could talk about the political consequences over time, but certainly you're seeing them right now in Europe and elsewhere.
If you put this equation together, it's that people don't want to invest in government bonds in quite the same way, and they're taking money out. So that 1% withdrawal that Goldman Sachs was talking about from, say, publicly owned U.S. government debts might be happening in a very real sense. It might not all be going to gold. It might be going to other asset classes. But this is something clearly a lot of investors are thinking about.
There's an obvious feedback loop here from policymakers, a more hectic environment into the markets, and for the markets back out again. You've got to make some tough decisions if you're a fiscal authority at the moment on how you're going to counter that if people don't want to buy your bonds for those reasons.
Yeah, are they going to make those hard decisions, though? Because people don't want them. They want their money. They want their benefits. And that's part of the problem that we see around the world.
Up next on the program, in the second hour of Bloomberg Surveillance, we'll catch up with Barbara Duran of BDA Capital, Monica Guerra of Morgan Stanley, Jed Dorsheimer of William Blair, and the former New York Fed President, Bill Dudley. From New York, this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is not a bond market which is not functioning. It's a bond market that's repricing.
I'm not overly concerned on this run-up in yield.
The distribution of rate outcomes is much greater to the downside than what the market is currently pricing.
We have seen fiscal concerns pretty much across the board.
That all reinforces at least a steepening bias.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Snap at a 2-day slide in yesterday's session, adding some weight to the rally this morning, up by 0.2% on the S&P 500. On the Nasdaq, up by 0.24. In the bond market, some stability thanks to some weaker economic data. The 10-year, sub 420, 2s below 360, and 30s backing away from 5%. 487 this morning. The data slate is stacking up as follows for this morning. Later on, 8:15, ADP, 8:30, jobless claims, all building up to tomorrow and a payrolls report.
There's a real question here about what it shows for the economy at a time when people are looking at this for a Fed reaction function to how much they're going to cut rates, right? It has to kind of thread the needle. Be weak, but not too weak. Be something that shows a softening, but not soft, and something that could give some impetus to Fed Chair Powell to cut rates in a significant way at the same time that we're seeing a lot of noise down in Washington, D.C. about who the future could be at the Federal Reserve.
A little bit of noise. Turn up the volume later on this morning. Stephen Myron down on Capitol Hill facing a grilling as he looks to get a seat in the FOMC. Put it this way, right now there is a credible argument to reduce interest rates at the Federal Reserve. Whether you agree or disagree, there is a credible case to make. Could Stephen Myron make that case at 10 a.m. Eastern Time?
He's certainly going to try. I think a better question going into the hearing today is anyone going to ask? Well, Republicans are going to ask, but Democrats aren't. They're going to use this hearing as a referendum on Fed independence and really try to get Stephen Myron to potentially go against maybe even what the President of the United States has said when it comes to Fed independence. But his confirmation is in no way in doubt. The issue I think that the White House is facing is, can they get him in the chair before September 16th? that is going to be incredibly challenging.
I'm going to say something, and I'm going to hear you both groan, okay? But when we talk about Fed independence, what does independence mean? Okay, I know that's the ultimate sort of Lisa thing to say. However, ultimately, that is a real question at a time where the U.S. deficit is increasing dramatically. And this Treasury Department is going to issue an increasing amount of it at the front end of the yield curve. In other words, short-term rates, which is what the Fed has some control over. So you can imagine that regardless of who is the president going forward, just by virtue of this profile, you have a more highly politicized Federal Reserve. And this really is the crux of the question that the markets are grappling with. What does that mean for inflation and for some of the changing metrics, the targets for the central bank?
I don't think anything you're saying is controversial whatsoever, so no groans from me.
Yay.
Going into next year, I think we have to shed the traditional way of looking at the central bank and get away from the Chairman Powell world and start thinking about the future and how this institution will be managed. And not just interest rates, but also the balance sheet. It's got to be something we give more thought to in the coming months.
And I think the market's trying to give this thought. And right now, long-term bonds are flirting with this idea of a regime change, but not necessarily buying into it because you still are seeing inflation expectations moored and you aren't seeing runaway yields. But that is the ultimate check. How does the market respond to what this looks like in the coming year?
This morning, we're down 2 basis points, 30s at 4.88. Coming up this hour, we'll catch up with Barbara Duran of BDA Capital as tech stocks rally ahead of jobs data throughout this week. Monica Guerra of Morgan Stanley as President Trump takes his tariff fight to the Supreme Court. And former New York Fed President Bill Dudley as Trump's Fed pick faces a confirmation hearing. We begin this hour with Stock Steady as investors await key job market data. Barbara Duran of BDA Capital writing job numbers will likely be on the low side and the jobs numbers indicate a continuing gradual cooling in the labour market. Barbara joins us now for more. Barbara, good morning.
Hey, good morning.
It's good to see you. Last time we caught up with you about a month ago, you talked about a market ripe for a pullback. Now, the data has pulled back, the market hasn't. How do those two things stack up?
Yeah, well, I think what's happened in the meantime is the Fed Jackson Hole, you know, where for the first time, you know, Powell really gave a very different message, which is that instead of just watching both inflation and jobs in terms of equality of interest there, it's now more concerned about jobs. And that was because the revised data, as we know, averaged 35,000 jobs a month for the 3 months, May, June, July. And so that was a significant difference. And I think that's, you know, it raises a big red flag, you know, for the Fed to think, hey, maybe we really have to focus more on that right now. Inflation, still expect the tariff impacts to feed through. That's been a lot slower than people expected. But it looks like now the job concerns are a little bit more ascendant in their concerns than inflation data.
So would you push back against the cyclical tilt that emerged through August into September?
I would a little bit, you know, because the concerns, what we're seeing, and of course we have jobless claims this morning, which I'd be surprised if they were anything less than stable, because that's been what's been happening. And tomorrow, of course, the non-farm payroll report, which I think estimates are 75,000. And again, it'd be hard to see that being even higher. You know, so we will see what happens there. But, you know, I think it's going to be steady state.
At this point, how can you bet against a market, though, that's being driven up by something completely independent from the economy, which is artificial intelligence and all the promised efficiency gains and cost benefits that companies are touting?
Well, I think that's an important part of it because that ties into the earnings story, which of course is what drives stocks. And if you saw the second quarter, expectations had been dramatically lowered after the first quarter, which was some 13%, and it was coming in at expectations of just under 5%. Well, it came in at about 12%. And if you look at the consensus estimates for next year, fiscal in the calendar year 26, you're looking at 13, 14% earnings growth. And that is still what's going to drive, and a big part of that is the AI play. But of course, it's been the expectation that in 2 weeks, the Fed will cut rates. And I think the probability, the CME is now 97+% that the Fed will cut rates. And certainly if you look to October, it's only about 50% there'll be another 25 bips cut. So it looks like interest rate cuts are coming.
Okay, so this is the reason why there is this feeling on Wall Street that it's a good time to be bullish, because ultimately the Fed's going to have your back one way or another. And it seems like there is a new bias on the Federal Reserve to run the economy just a touch hot in order to preserve jobs and sort of keep things stable, even at the expense potentially of inflation going higher. How much are you incorporating that sort of shift in bias into your investing view?
Well, it's a good question because you've seen the rotation until yesterday, the typical rotation out of the big mega cap tech stocks, which are always going to be vulnerable to profit taking when you feel that you want to invest in other areas. And so I think that's, people are looking, you've seen the small caps have a big run. In fact, in August, you had the biggest outperformance differential between the NASDAQ 100, which was, I think, about 1.3% versus 7+% for small cap. Now, I personally see that as a trade. I don't think that's sustainable because, again, there is uncertainty about the economy. Job market is slowing. We haven't seen the layoffs yet, so people are still employed. You still got decent wage growth, and you still have some 40, 50 trillion has been created since 19 in household wealth. So people are wealthy. Not to say the lower income is not being stressed because of the tariffs, the regressive tax impact.
What would need to happen for you to take that thought that this is a trade and actually something more sustainable?
Well, I think we'd have to see the economy holding up. I think the Fed would have to cut rates. We've got a number of data points coming up, whether it's the CPI, PPI, jobs reports. And if we maintain, a level of jobs in the economy, I mean, you see how the GDP growth this year probably will average 1.5%. That's not huge. I mean, it's okay, it's sustainable, but it doesn't indicate an economy that's going to take off and benefit cyclicals and small cap.
When you look at the data coming up, didn't Chairman Powell just give the market a green light to look through inflation data?
Looks like it. Looks like it, but they're also being very careful, and I think there's still, and certainly in my view, is that we just really got the final tariffs. Well, we'll see what happens with India and some others, but in August. So there's a lot of tariff impacts that have not fed through, and we know that there's big inventory building, and companies without knowing what the impacts are going to be pushed it back on their supply chains. They took some of the hit, but they're going to, now that they have some clarity, they're going to start to figure out, we got to push, we got to raise prices. That will happen, but it's taking longer than everybody expected because there's been such uncertainty on the policy level. So Fed is still very aware of that, and you certainly hear this from Fed commentary. Around the street, some are saying we still don't need to cut rates. So we'll see.
Stuart Kaiser of Citi was on the programme a little bit earlier, and Stu was making the case for a sneaky bull case. And a sneaky bull case in his eyes is ultimately that we get this reacceleration, we get growth starting to inflect higher as we turn the year, go into year end and come out the other side. What I hear from you, though, is that that's not the sneaky bull case. Actually, that's the base case, and that's what we're priced for, a reacceleration in growth. Is that fair?
Actually, I think that is fair because, again, it's all about earnings. And we saw it, a lot of companies raised their guidance, and it wasn't just because they had cut guidance, in the uncertain time period in April, but it's really looking ahead. And of course, companies are very cautious, in looking ahead in terms of their guidance. So you're seeing, pretty rosy picture. And again, anything could happen. You could start to see more layoffs, but it's been such a gradual cooling. And of course, we have to see the impact. I mean, they're really stepping up the deportation. That is going to have an impact on the lower level jobs. If they, at this current rate of 3,000 a day, and it looks like they want to hire more ICE officers, that's probably in a year 1 million workers taken out of the system, and we'll see what impact that has.
So if you're cautious, what are you buying and what are you selling? Are you selling stocks and buying bonds, or does that no longer work?
I am not buying bonds, and I continue to sell on a risk management viewpoint, whereas things like NVIDIA, or we're going to have Broadcom after the close today, and trim profits there. I think there's been, some international has been an outperformer, and I think that can continue for various reasons depending on the market, but that's also, it's a fiscal thing. It's also what's happening in terms of their economies. So I think you can start to go in that direction, and I think you continue to look at different AI plays that are developing and will continue to develop.
I think that's a pretty interesting response. Bottom line, you're expecting growth to disappoint, but ultimately, you're not buying bonds. Now, what is it about bonds right now that don't provide that diversifying characteristics that typically they would provide in a disappointing slowdown?
Well, I think it also depends on, I really think stocks are the way you create wealth, and bonds are really a placeholder. And bonds, even with, if you go out on the curve or do high yield, you're still not making a lot past inflation. And so you had a guest on earlier talking about non-correlated assets, and that's a different direction one can go, where you can get higher returns than bonds, and they will be not correlated. But bonds, I mean, you saw the freight that happened earlier this week, and we saw this back in April, where suddenly, because of the tariffs, that may be rolled back, okay, what happens to the fiscal deficit? And so the bonds freak out, the long end, but then they settle down because it's sort of out there in the future, and the market really responds to what's immediate and foreseeable in the next, say, 12 to 18 months. So I think we will periodically have these rates, concerned about fiscal, our fiscal situation. But again, that fades, and also because we're in a unique place in the world in terms of our, the U.S. dollar. We are the reserve currency.
Yeah.
So.
Barbara, it's good to see you. Thanks for dropping by. Barbara Durand there of BDA Capital. This morning, bonds are doing better. Yields are lower across the curve by 1 or 2 basis points. 30s down to 488, 2s at 360. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. You all mentioned this one earlier. American Eagle shares are soaring 26% in the pre-market after the retailer reported higher than expected quarterly sales. boosted by demand from its Sydney Sweeney ad campaign. The company's chief marketing officer said that in just 6 weeks, the campaign has generated unprecedented new customer acquisition, with, as Anne Marie said, new shoppers gained in every single county in the U.S. Meanwhile, the effort to ban individual stock trading by lawmakers is gaining momentum. A bipartisan group in the House introduced a bill that would ban members of Congress from owning and trading individual stocks. The bipartisan legislation comes on the heels of a similar measure which advanced in the Senate and is awaiting a floor vote. And the Metropolitan Opera has reached a deal with Saudi Arabia that will have the company perform in the kingdom for 3 weeks each winter. The agreement, which is expected to bring the Met more than $100 million, is expected to cover a large portion of its financial needs through at least 2032. The Met hopes this will help it amid a period of acute financial stress. That's your Bloomberg Brief. John?
They can stop calling me now. Always get phone calls from them.
You get calls from the
Looking
Met?
for donations.
Really?
All the time.
How
all
often
the
do you
time.
go to the opera?
I screen those calls now.
Oh, yeah, is that right?
in October. You should come with me, John.
What are you watching?
Andrea Bocelli is coming to town.
Okay, that sounds quite cool. I mean, to be fair. All right.
So they're going to keep calling,
They're
basically.
going to keep calling,
because
basically.
Call him now. He's interested.
Green light.
That's what
Call him.
happens. All right, let's move on. Up next, Trump's tariff agenda on the line.
We have a very, very big case in the Supreme Court. If we don't win that case, our country is going to suffer so greatly. I think it's one of the most important cases I've ever seen go before the Supreme Court.
Up next, we'll catch up with Monica Guerra of Morgan Stanley from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Live from New York City this morning. Good morning. Here's your day ahead. It's stacking up as follows. Tons of economic data later this morning, 8:30 Eastern Time. Jobless claims before that. Typically, we don't make a big deal of ADP, but given what's been happening with payrolls, more and more people making a bigger deal of ADP. That drops at 8:15 Eastern Time. Then later on, at the same time, we get the ISM, which is worthy of a few looks. We also get this one. Box office on Capitol Hill. Stephen Myron and his confirmation hearing in the nation's capital.
So expect a lot of questions about his idea of Fed independence, especially given that paper that he co-authored last year, talking about how maybe the way to give the Fed a greater degree of credibility is to give the president more authority to fire at will a number of the members. There are a lot of questions here. Key question for me is, how does the market respond? How much is the market paying attention to this? And that, to me, is the reaction function that might have the greatest meaning, not only for the market, but also for Congress.
And unlike the economics profession right now, this market's not losing its mind. Some people might say it's being complacent, but ultimately, it's not losing its mind.
In part because they believe in that check, right? That ultimate check of the market, but also because you're not seeing inflation expectations become unmoored. And in fact, a lot of the inflation data, as we've been talking about, have been coming in better than expected.
Equity futures this morning doing better than expected again, up by 0.2%. The bounce back continues on the Nasdaq 100, higher by 0.3 in the bond market. Bonds are doing okay. We're stable here. Yields are down by 2 basis points on 10s to about 420. Under surveillance this morning, the president's tariff agenda on the line.
We have a very, very big case in the Supreme Court. If we don't win that case, our country is going to suffer so greatly. I think we're going to have a big victory. These deals are all done. I guess we'd have to unwind them. And I used them wisely, and people respect America again, and we've become a rich country again. The money coming in is incredible. I think it's one of the most important cases I've ever seen go before the Supreme Court.
So here's the latest this morning. The president calling on the Supreme Court to uphold his global tariffs. The president seeking a highly expedited schedule for the high-stakes case. Joining us now from Washington is Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. So the White House is asking the Supreme Court to hear arguments starting in early November. That would open the door for a decision by the end of the year, though worth pointing out that the court's term goes until the middle of 2026, so that's by no means a sure thing. But the White House is certainly pushing its case, saying that it's actually complicating ongoing trade negotiations. And we know that trillions of dollars are tied up in the decision. Now, I mentioned this earlier this week on the program, but I was pretty struck by the Committee for a Responsible Federal Budget, which is projecting that 71% of anticipated tariff revenue would vanish if the Supreme Court ultimately upholds this decision. And our own analysts at Bloomberg Economics are estimating that the average U.S. tariff rate would be cut by more than half. Now, at issue here is that this appeal covers 2 instances where President Trump invoked IEEPA, the International Emergency Economic Powers Act, to declare national emergencies and then impose tariffs. The first, the so-called reciprocal tariffs, where he cited persistent global trade imbalances, and the second, the tariffs against Mexico, Canada, and partly on China, where he cited concerns when it comes to the border and fentanyl. So the 2 big questions that the court really needs to decide here is, 1, does he have the authority under IEEPA to impose tariffs, because we've never seen this done before, and 2, did he invoke IEEPA correctly here? Did these national emergencies rise to the legal standard of being what's known as an unusual and extraordinary threat? All of this to say, John, this is going to be very consequential, but we do know that the White House is preparing other ways to use tariffs. A person familiar tells us that the administration right now is preparing other federal authorities that could invoke the levies depending on how this court case goes, even as they are optimistic about their appeal in front of the Supreme Court.
Tyler Kendall with the latest in Washington. Tyler, thank you. Moved the goalpost a little bit here, haven't we? It was about bringing production home. And now it seems almost exclusively this is about raising money.
Well, that's the one that's more popular with markets, especially given the fact that the CBO is estimating $3.3 trillion of revenue over the next 10 years if these tariffs stay on at this level. There is a question of how much production it moves back to the U.S., how much that factors into the court case, and I actually am curious where the emphasis lies to give clues as to what tools they will use going forward.
Joining us now is Monica Guerra of Morgan Stanley to discuss some of this. Just how much deficit risk is in play with this court decision?
A significant amount. You know, the OBVA added, $4.5 trillion to the deficit in the last, estimate that they gave when they modeled things out. When we're thinking about this revenue, we're looking at about, $20 billion plus a month. That's a huge shift. It was $5 billion prior monthly. So again, there's a lot at risk here when you're looking at that $2 to $3 trillion range of revenue that they're expecting. That's enough to really offset a lot of those budget hawk concerns, right, especially around the deficit.
And this is one reason why markets haven't freaked out at some of the budget deficit concerns. There is a question of why there hasn't been more of a response in the long end of the yield curve to this court ruling. And some people argue, well, that revenue will keep coming in regardless one way or another. Do you agree with that?
Yeah, so it's our base case that even if the Supreme Court does rule against Trump, that, if there's a will, there's a way. And we've seen that not just through them exploring other options of levying tariffs through different federal agencies, but also through different, sections of tariff law, Section 232, Section 301. There's a ton. There's a whole list. We recently published a report where we really get into the details on each one, the timeframes, how it works. And while some are limited, they can layer these, and there are some that are more long-term. So there are options out there, and I think that markets understand that, and that they're trying to look through any volatility around the Supreme Court.
The direction of travel is clear. They're going to find a way to increase tariffs, even if the Supreme Court does strike this down. But do you think the Supreme Court, is that your base case? Will they uphold IEEPA, or will they strike it down?
I'm not the expert on the Supreme Court, but what I can say is I think that there is a strong likelihood that they will rule in favor of the president. And then if not, right, it's just how do we get there? And we also have to remember that right now the tariffs are still in place. So it's not like they've completely rolled off. We're still collecting revenues, right, as we go along. And even if we do end up with a patchwork and say you get 10 billion a month, that's still double what we were receiving before, and that is a help towards that deficit.
How messy is that unwind going to be, though, if they were going to have to potentially give back some of those funds?
I mean, it would be messy. If you're thinking about even negotiations with the EU, they're trying to proceed as business as usual, but they're being very cognizant that some of these things may have to be unwound if things are unstable. Now, what's interesting is that when other foreign entities have been asked in the recent days, how are you approaching this? They're still continuing negotiations as if things are in play. And so we have to, keep that in mind, that there's a strong belief that tariffs are coming one way or the other.
So this sounds very technical, but I have been getting a little bit overly technical recently. The stay from the court only goes till October 14th to keep these tariffs on. The Supreme Court has to decide to take this up and then rule on it, and that stay expires. What happens then? I mean, can't companies go to the government and say, can you give me my money back because I paid you a couple $2 billion?
It's unclear to me if that's retroactive, right? So if you're already paying, I'm not sure about the logistics there. I doubt it is. I'm sure the money that the government has collected will stay in the Treasury where it's safe and sound. I would say the biggest concern for us from a markets lens, right, is that if there's more volatility here, especially for businesses come October, are people going to hold cash on the sidelines? Are they going to continue to wait on, say, CapEx expenditures? What is the longer-term economic impact, right, from that volatility, especially if they're waiting October to November to get that decision?
It has the potential to impact pricing strategies of corporations as well. If you think they're sitting on their hands waiting to find out what happens here, they're not going to pass it on to the consumer just yet. Most people believe that's what's been happening over the last 2-3 months or so. They're going to have to wait even longer. Can you imagine sitting there in the C-suite right now, trying to come up with the appropriate price to put on a product? You've got to believe that the tariffs are going to stay before you really think about passing that on.
This is the reason why people expect that sort of sneaky bull case to be that reinvestment cycle. How at risk is that? Should there be some sort of, prolonging of this uncertainty?
Well, to your point, Lisa, the Supreme Court, there ends the next term, June 2026. That could potentially be when we get a final decision. And this is why the Treasury Secretary had this declaration, part of the submission yesterday, saying that would be, the unwinding of this would be maybe $1 trillion in tariffs that have already been collected. And he says this could be significant disruption.
It's amazing how much the bias has shifted in financial markets, seeing these tariffs as bond bullish, bond positive, when back in April, it was very, very bond negative.
Right now, people have no clue what the long-term impact is. They're looking at the short term. The short term is money's coming in, and that looks nice. And that's basically what Wall Street's betting on.
Monica, this was nice. It's good to see you, as always. Thanks for being here. Monica Guerra there of Morgan Stanley. Up next on the program, Jed Dorsheimer of William Blair on AI's impact on the US power grid. Plus, we'll touch base with Danny with your morning movers as Goldman Sachs looks to invest as much as $1 billion in T. Rowe Price. That stock is up 7%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Stock still just about positive, up 0.1% on the S&P 500. On the Nasdaq, up by 0.2. Yesterday's bounce supported by Apple, supported by Alphabet. Equities are doing okay. In the bond market, the bond market's doing okay as well. Check out the 30-year and just think about the range we had yesterday. Within a basis point of 5% on 30s in yesterday's session at the highs. At the lows, 488. This morning, 487.45 and down 2 basis points on the session. Bailed out in many ways by weaker than expected economic data. And Lisa, I've got to say, there was a lot of it. It wasn't just job openings. The beige book, which you teased and promoted yesterday, turned out to be dreadful. And if that's the Fed's read on what's happening in this economy right now, no wonder they're pivoting to rate cuts.
Because you ultimately see stagflationary types of dynamics. You saw almost no districts that the Fed surveyed showing growth. There was essentially a stagnation at the same time that companies are raising prices. You're seeing this in the JOLTS data with job openings coming down to the lowest levels in about a year. You put this all together and you think about maybe bad news is bad news longer term, which will give a bid to bonds and maybe cap how high inflation can get.
Later this morning, more data. 45 minutes away, ADP. 15 minutes later, jobless claims. And then at 10 a.m., don't forget, ISM services, worthy of a look as well. That's the latest with the economic data. 2 hours away from the cash open with your morning movers. Here's Danny. Hey, Danny.
Hey, John, some breaking news in the last 30 minutes or so, and that is Goldman Sachs will be buying a $1 billion stake of T. Rowe Price. Buying those shares means that it will become its biggest shareholder. All of this part of a new partnership between the two of them to make more products, be it for public markets or private markets, really trying to gear towards the retail audience, something that Goldman Sachs Asset Management has been trying to get into beyond their wealth offering. So those shares up 7.7%. Elsewhere on the move this morning, we are looking at Snowflake shares falling more than 1.5%, announcing that its CFO, Mike Scarpelli, will be retiring effective September 22nd. Probably something he would like to see his shares falling on that retirement announcement. Probably not great for his replacement, Brian Robbins, who will succeed him. He is coming from GitHub, where he is currently serving as the CFO and has been since 2020. Finally, John's favorite story this morning, and that is American Eagle. Really strong sales numbers. And they specifically said it was because of the Sydney Sweeney campaign, saying that her signature jeans sold out everywhere, that they gained more customers in every single county of the U.S. The CEO saying that the momentum is national and it is real. So, John, those shares up just under 27%.
Danny, thanks for the update. Appreciate it. Look, my take on things, and this doesn't apply to every single company on the planet, but for most, I believe, they don't have values, they care about sales. And if you're seeing American Eagle have success with what was a quite polarizing strategy from them, I wonder how many other retailers are going to lean into the same thing in the quarters to come.
You're already seeing it in some degree in terms of the advertisements and how much they're talking about made in America, and they're talking about it, you know, what it is to be attractive to the opposite sex and things of that nature that were diminished, I think, in previous years.
Well, Abercrombie & Fitch is trying to lean into this, and they're doing this whole tie-up with NFL. Brittany Mahomes, a friend of Travis Kelce, is going to be wearing more Abercrombie & Fitch. So I think they're all trying to find their own way to lean into this Americana aesthetic.
Which makes the Cracker Barrel decision even more ridiculous. If you can see this is where the country is trending, leaning into heritage Americana, you can see that polarizing decisions like this one turn out to be beneficial to the bottom line and the top line of the company. What on earth were they doing over at that company?
Well, if you're a conspiracy theorist, you might think they did this purposefully to actually get their name out in the press. What did Cracker Barrel get at the end of this? A phone call from the deputy chief of staff of the White House. I could see a moment where you see the president on the road, he stops into a Cracker Barrel, and he said he's making it great again.
American Eagle up by 27%. Wanted to talk about the data just briefly. This coming in. Hiring intentions. Challenger job cuts. Lisa, this data's not good. Not good at all.
And when you look deeper into this data from Challenger, Gray, and Christmas, it shows that hiring plans among the companies they surveyed fell to the weakest level for any August on record. This highlights the sort of churn dynamic where maybe companies are not laying off a great number of workers. They are increasing layoffs, but they're not hiring. We're seeing this also with on-the-margins firing. Yesterday, ConocoPhillips planning to cut 25% of jobs from their staff. You put this together, that's the churn dynamic that's given some people some agita.
One more data point on the labour market, one more data point that doesn't look great. On our radar this morning, let's whip through some stories for you. President Donald Trump taking his global tariff fight to the Supreme Court. The administration asking the High Court to take up the case by September 10th and to put it on an expedited schedule, with arguments expected in early November. Elsewhere, President Trump's pick for Federal Reserve Governor facing a Senate confirmation hearing today. Stephen Myron saying he will preserve the independence of the central bank as the president vows to gain a majority on the Fed. And finally, tech industry leaders attending an AI event at the White House today. The First Lady, Melania Trump, hosting CEOs from Meta, Apple, Microsoft, Google, and more. The event will be followed by a reception with President Trump in the Rose Garden.
With a real discussion around how to expedite some of the use of AI in businesses, in schools in particular. This is a big issue. I was really struck by the pavers they put over the Rose Garden. They took away the grass. I just was really struck by that. I
have a lot to say about this.
Okay, but it really, to me, highlights how they want to make these the national champions at a time where there's this real tension, especially after the Google case and this question about what they could do with antitrust or not. How do you make national champions while also clamping down on things that are a bipartisan issue?
Two things, notably one individual missing that you would have in an event like this, Elon Musk. He is clearly still very far from the president, have fallen from the graces of the president. Two, the Rose Garden. Those umbrellas. The president must be missing Mar-a-Lago. And you heard a White House official say the Rose Garden Club is the hottest thing in town. Put up the pictures. Those umbrellas, those yellow umbrellas, I don't know if you've been to Mar-a-Lago. They literally look like the patio in Mar-a-Lago. When I was there last week, waiting to go into the cabinet room, the president was actually also showcasing and playing his playlist. The same playlist when he DJs at Mar-a-Lago, he's now doing in the Rose Garden. You can hear it every single day.
Is that the rant?
That's the rant, yeah.
That's the
it's
rant.
a little weird,
And
no?
that's the umbrellas. I'm with you, I'm following it. Are you saying this is going to be a membership scheme in years to come?
It literally sounds like this is his new club, and he's having his first party, it sounds like today, with, the tech world.
Save the grass.
Are you on the grass back?
Yeah, I just,
Wasn't this about high heels and being able to walk?
The president said it's a big issue for the ladies with their heels, which I do actually have.
Wear sneakers.
Well, it's hard to wear sneakers because if you're in a suit, your pants are hemmed. I do feel for the ladies that have to wear their heels in the grass. I've been one of them. But at the same time, now it's just all this pavement and it's a little weird.
The important stuff right here on Bloomberg Surveillance. Let's turn to the AI race. Barclays predicting Wall Street could see a $100 billion plus M&A deal in the sector by this time next year. Jed Dorsheimer, the group head of energy and power technologies for William Blair, writing the following. Demand for data center growth has been building for the past 20 years. Until recently, this demand was manageable. Jed joins us now for more. Jed, welcome to the program, sir. Let's spend some time on this. What is making it increasingly less manageable? What makes it unmanageable right now?
Well, I think it's just I think we have been lulled into this complacency of maintenance for the past 50 years, where we've, gotten used to, 0.5 to 1% type growth in terms of capacity. And now all of a sudden you're seeing this surge driven by the race to build these data centers and the CapEx spend. And quite frankly, the grid, which used to, how we built that grid out, which used to be around firm baseload, a lot of the variability that's been brought on by renewables is just making this incompatible. And that's what, that's the friction that we're seeing in the within our power sector.
Jed, could you just illustrate to us, just spell out for us directly, just how great demand for electricity has been, and a point that I know you want to make, just how unevenly that demand is dispersed across this country?
Sure. I mean, listen, if you want to, the nexus for data centers is in Virginia, but what you are seeing is states where you have cheap or therefore firm base load, where you're seeing it's not an even disbursement in terms of who's benefiting from the CapEx. So it tends to be south and southeast, as well as some of the mountain states such as Idaho, Wyoming. And, I think that, so it's never been an even spread, but I think that, both of the coasts have largely been a beneficiary, and now you're seeing a pretty dramatic change with respect to where people are building out. And that is, those decisions for these data centers are being built around where you have access to energy locally.
Jed, how do you map out a long-term plan that backstops some sort of big infrastructure project at a time when technology is changing pretty significantly and quickly? The news overnight was that DeepSeek over in China is preparing an AI agent that can compete with OpenAI, and it just goes to this idea that maybe eventually a lot of the artificial intelligence can be done more cheaply, more efficiently, without as much energy. How does that factor into some of the models that people have for projects that span out decades ahead?
So it's a great question. It's one that I'm receiving all the time. That's probably, but I want to point out, you said, cheaply, efficiently, with less energy. Those three don't match up. And so there's this concept known as Jevons paradox by economist William Jevons back in 1865, who was asked to look into the efficiency of coal. And this is held up throughout time. So technology is deflationary. So technology will drive down costs. But as the social utility for that technology increases, the use model always goes up. And so I'll give you an example. When I grew up, my parents' car got maybe 5 miles, 7 miles per gallon. Today, the typical automobile, non-hybrid or electric, is getting 35 miles per gallon. What happened was people bought, my parents now have 2 cars, and they might, they drive more. And so and I think the same is going to happen with AI, that as the technology becomes cheaper, the use will go up. Therefore, the energy that's needed to provide, even if you get to models and agents that are more efficient, it's only going to proliferate, and that's going to require more energy.
When it comes to energy, what kind of sources are you talking about, Jed?
Well, I think the primary beneficiary is going to be natural gas and going to be nuclear. And the reason being is what we're starting to see is the real economics behind variability. So while solar and wind sound great, it's wreaking havoc on the grid. And there's really, you can solve some of that with batteries, but it certainly pushes up the cost of that. So the conclusion that we've come to, and we did a statistically significant study with 531. It was a meta-analysis with 531 different data sets. And what we found was that as you get over 10% on a grid, and the U.S. is split up into 7 different grids, as you get over 10% penetration of variable assets, that the variability actually usurps the asset cost. What does that mean? It means that there's no benefit. It only pushes up prices. And people are already feeling that squeeze. I've got this saying, pain at the plug. And I think that's going to be a meme that becomes more popular, because we usually talk about it at the pump in terms of oil prices, et cetera. And I think the squeeze is going to be on the electricity bills from all of this.
Jed, it's already happening, and I couldn't agree with you more. I think by the midterms next year, this is going to become a really big political issue. Jed, appreciate your time, sir. Let's do it again soon. Jed Dorsheimer there of William Blair. That's going to be potentially one of the #1 issues alongside housing affordability in the next 12 months.
It's already been an issue in Washington. You see a number of members of Congress concerned because their constituents are saying, my electricity bill is coming up, and guess what? You have these AI companies, tech companies coming in and just having this massive demand when it comes to wanting to power all their technology and all the energy that's going to be needed for this. What Jed's point was the fact that you're going to need natural gas, you're going to need nuclear, you're going to need every single source of power to be able to do this.
We've got lots of economic data coming up this morning in about 30 minutes' time, the ADP report after that jobless claims. Before we get there, let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Harvard University scoring a major legal victory in its battle with the Trump administration. A court ruled that the U.S. illegally froze more than $2 billion in research funding. Judge Allison Burroughs said the administration violated Harvard's free speech protections, as well as U.S. civil rights and administrative laws. Meanwhile, the New York Giants have agreed to sell a minority stake in their storied franchise to Julia Koch and members of the billionaire Koch family. The deal is for 10% of the franchise at a record valuation of $10 billion, according to Sportico. A sale cannot be finalized until it is presented to other NFL owners at a meeting in October. And speaking of sports and deals, Bloomberg hosting its annual Power Players event today in New York City, set against the backdrop of the U.S. Open. Bloomberg Power Players brings together influential voices like the ones behind me from the business of sports to identify the next wave of disruption that could hit this multi-trillion-dollar global industry. Check out all the coverage on the terminal on LiveGo. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next on the program, confirming Stephen Myron.
He would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time.
In just a second, we'll catch up with the former New York Fed President, Bill Dudley, from New York City. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment, and we are seeing increasingly GDP is increasingly become overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Stocks are positive, just about, up by 0.1% on the S&P, up by 0.2 on the Nasdaq 100. Bonds are stable, 2-year, 10-year, 30-year, twos at the front end of the curve, near the lows of the year at 360. At the long end of the curve in yesterday's session, backing away from 5% off the back of weaker than expected jobs data, job openings lower. Also a pretty disappointing negative read on the economy in the beige book. Then this morning, Bramo, challenger job cuts. Now, I know typically we don't make a big deal of this, but it just reinforces the current view, which is this labour market has slowed down.
And frankly, hiring plans just are not there. We're already seeing that with the excuse of artificial intelligence, but it's a convenient excuse at a time where you're trying to plug gaps to not necessarily hire anybody new. Everyone who I talk to among the retail CEOs are making their money by cutting costs. How are they cutting costs? On the margins, attrition, not necessarily hiring as much, and you're seeing this across the board.
More jobs data about 30 minutes away, 25 minutes away, the ADP report just around the corner. And the surveillance in Washington, D.C. confirming Stephen Myron.
The president has great sway with Leader Thune. Leader Thune's been a great partner during the tax deal, and I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. By putting Stephen Myron in, that gives us more time. And again, I want to cast a wide net. The president's very open-minded.
So here's the latest this morning. President Donald Trump's Fed governor nominee, Stephen Myron, emphasizing his commitment to Fed independence, writing in his opening remarks, "My opinions and decisions will be based on my analysis of the macroeconomy and what's best for its long-term stewardship." The former New York Fed President, Bill Dudley, joins us now for more. Bill, welcome back to the program, sir. I imagine you'll be tuned in later on this morning when that hearing begins. Bill, what would you like to hear?
Well, I think that he's already foreshadowed what he's going to say. The Senate is worried about compromising the Fed's independence, and that's probably the only thing that could hang up this confirmation hearing. And he's already stated in his opening remarks that he's going to honor that. Obviously, what that means in practice once you're in the Federal Reserve what remains to be seen. But he's going to say the right things, and I expect him to get confirmed.
Bill, I imagine that you're very focused on Fed independence, and I understand why. But when you look at financial markets, we haven't seen a major de-anchoring of inflation expectations. This hasn't showed up in a dramatic fashion. Do you see anything to be concerned about?
Well, I think that what President Trump is trying to do is unprecedented, trying to fire a sitting Federal Reserve governor. Whether that ultimately leads to majority control of the Board of Governors, and then what does the Board of Governors do with that majority control? People have speculated that they could make decisions about the renewal of the Federal Reserve Bank president's terms when they come up in February of next year. But I think, we don't really know where this is going to go. I think the effort, though, is unprecedented. So I think you have to take it seriously. I think at this point, markets are still pretty comfortable about this. I think probably a little too comfortable given the fact that the president is trying so hard to influence monetary policy. But how this plays out, there's a long way to go.
Bill, though, when it comes to what's going on in terms of potentially having the reinstatement of the regional presidents, that would mean that Governors Waller and Bowman would need to sign up for that. You know these individuals. You think that's something they'd be interested in doing?
Well, I think I think you got exactly right. You could have 4 people that were Trump appointees on the board of governors, but not all 4 might not agree to go so far as start to really change the composition of the Federal Open Market Committee by not reappointing presidents. So I think and I think that's one reason why people are pretty optimistic that this worst case scenario in terms of Fed independence is not going to happen. That said, we're already seeing actions that are unprecedented, and that's not the only thing that the president potentially could do to undercut Fed independence. So the very efforts that he's making, I think one has to take it seriously because the process in the game isn't over yet.
Well, when you look at this unprecedented action, I think you're talking about what's going on with Governor Lisa Cook. But what happens if she is charged basically with mortgage fraud? Wouldn't that be for cause for the president to say she doesn't have the trust in the public?
Well, I think there's 2 issues here. The first issue is what does for cause mean in terms of can you dismiss someone for cause unrelated to their actual performance on the job? Most people have interpreted for cause meaning negligence and gross incompetence, malfeasance in the execution of your job. The second issue, though, with Lisa Cook's issue is if she were to be found guilty, the question is even if the president doesn't have the authority to remove her, is it really tenable for her to stay on the Fed at that point? So I think there's also the question about, could she stay on the Fed if she was found guilty, even if the president was found to not have the authority to fire her?
You sit on the Bretton Woods Committee, Bill, and I really am trying to think more broadly here about what Fed independence means right now, given the fact that the United States has a huge deficit, and increasingly it is more pegged to Fed policy than ever before as it gets issued increasingly at shorter denominations. What does Fed independence mean when these are appointed individuals with inherent views on exactly how hot the economy should run and what the compromise should be when it comes to how quickly to bring down inflation to 2%?
So the way I would interpret Fed independence is it doesn't mean the Fed can do whatever it wants. The Fed has to basically follow the guidance of Congress in terms of its objectives. And Congress has said the objectives for the Fed are maximum sustainable employment and price stability. So those are the objectives. What Fed independence means is the Federal Reserve should be able to conduct monetary policy independent of political pressure to achieve those objectives. And the problem with, compromising the central bank's independence is that the central bank loses credibility. People start to ask the question, is the Fed cutting rates because that's the right thing to do, or is the Fed cutting rates because they're under political pressure? Obviously, the election cycle plays into the president's calculations, does not play into the Federal Reserve's calculations. And one reason why central bank independence has become very prevalent around the world is it leads to better economic outcomes. It allows the central bank to take the longer view, not to overstimulate the economy and run up to elections, and then not have to slam on the brakes after the election when inflation actually starts to be realized. So Fed independence leads to better economic outcomes, and that's why it's got broad support around the world.
Bill, appreciate your time, as always. It will be an interesting one in a few hours' time. Bill Dudley there, former New York Fed president. Neil Dutter of Renmark joins the program a little bit later this morning, writes in, the sanguine nature of the bond market is a combination of the president is right about rate cuts, AI will bring down disinflation, and he won't get away with any crazy stuff.
Is this market that's assuming that this is a politically motivated Fed, that they're going to cut rates, that's going to keep everything kind of humming along, and no one's thinking about what happens if the economy actually isn't doing well and what that does to the broader risk asset sphere?
This Fed has been recklessly dovish for years. I mean, that's the Fed that this whole market's used to.
And it hasn't gotten inflation down to 2% for years as well.
There you go. What's going to be changing?
Well, that's really the ultimate question, and that's what I'm really curious about over the next few months.
I'm with you, particularly on the balance sheet.
Yeah.
Anyway, we keep coming back to that. Up next on the program, we'll catch up with Omar Aguilar of Schwab Asset Management. Neil Dutter of Renmark will be with us too, and we'll have that jobs data about 20 minutes from now.
So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed, and there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think, could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
This is still a tech-driven market.
Large cap U.S. market itself has been the place to be.
In general, things have been drifting more positive.
Valuations are toppy, but generally firms are performing.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, this is it. I don't think I've ever done this before. 15 minutes away from the ADP report.
I'll remember this.
This is where we're at. All right, from New York City this morning. Good morning to all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive on the S&P by 0.15%, up by 0.2 on the NASDAQ. In the bond market, well behaved so far this morning. Sub 5% on 30, sub 360 on 2s, sub 420 on 10s, 418.58. And the next hour looks like this. 8:30 Eastern Time, jobless claims. But 15 minutes before that, the ADP report taking on additional importance over the last month.
Especially not only because of the firing of the BLS head after the last payrolls report, but also because revisions have actually brought the headline payrolls figure down to where the ADP is more consistently. So there's actually been more correlation than there has been in the past. Look, what we're going to get is the 1-2 punch that shows the low hire, low fire type of dynamic, the churn in the labor market that we have seen that has marked the past, say, 6 months. It continues. At what point do we reach a breaking point? And I wonder if when we look back on today's data, if the Challenger Gray and Christmas data showing low hiring plans from companies might end up being the most relevant data point
of the morning.
Well, it's the second-tier data, as some would say, but it's becoming more important because of also how people have basically just been putting some cold water on the first-tier data, which would be tomorrow. But tomorrow, if we get sub 100,000 employment job growth added, that would mark the weakest stretch since the onset of the pandemic. And the question I have is this real weakening, or is this what Stuart Kaiser said earlier? Did corporate America take a siesta for 6 months and then potentially second half of this year, when all this policy uncertainty is basically getting wrapped up, we can actually potentially see corporate America go back to labor market?
This is what he would call the sneaky bull case, the re-acceleration. I'm not sure how sneaky it is. Increasingly, that's what the market has positioned for since the start of August. A re-acceleration with small caps outperforming. I've talked about the home builders, the airlines. Banks came into September at or near all-time highs. This market's been positioning for exactly that bull case.
This is the conundrum, though. A lot of this has followed earnings, which also have re-accelerated, and the earnings growth has been better than expected, but it has come without a re-acceleration in hiring. So this goes to the questions around artificial intelligence, technology. Is there something else at play here where you could see profitability increase and not see commensurate hiring plans, not seeing it trickle out to the rest of the United States economy?
Some tension building there between jobs and this market, potentially. More jobs data, 12 minutes away. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks trade near all-time highs. Neil Dutta of Renmac as investors are gearing up for jobs data, and Subhadra Rajapra of SocGen as the 30-year Treasury yield backs away from 5%. We begin this hour with stocks edging higher ahead of key reports on the labour market. Omar Aguilar, Schwab Asset Management CEO and CIO, writing, economic uncertainty is still high, so think long-term. Stay disciplined, stay invested, and stay diversified. No need to be a hero. Omar joins us now for more. Omar, welcome to the program, sir. Let's talk about that economic uncertainty. How are you getting a clean read on the economy in America?
Well, you know, the big part of the trade-offs right now between inflation, unemployment, economic deceleration, and overall, you know, the path that we're seem to be going here, it is unclear how the consumers are actually driving, you know, the majority of economic growth. We have seen so far this K-shaped economy where the top end of earners continue to drive GDP growth, and the wealth effect coming from equity markets, coming from housing, coming from anything else seem to be very consistently supporting economic growth, where the other part of the economy, the lower income consumers, seems to be, you know, suffering from, you know, the pressures on inflation, the increasing in prices. So that sort of K-shaped economy seems to be the one driving a lot of this economic uncertainty, and the trend seems to pointing out towards deceleration.
No need to be a hero. I keep thinking about that. The implication is focus on quality, as you say. What does quality mean? How is the idea of quality changing, given the backdrop potentially of inflation, the backdrop given of slow growth with this sort of persistent price pressure?
Yeah, the big part here, Alyssa, is that we have these forces that are sort of going at each other. You know, inflation seems to be very sticky and stubborn. We've seen the economic value and the unemployment being in these no hire, no fire situation. We see wage growth still ticking up a little bit, putting pressure on inflation, and something at some point is probably have to give up. What that means is that in certain way, the deceleration supports stronger balance sheets, supports discipline in management, supports capital expenditures, supports areas that define the quality of a company, where corporate America is using all the potential tailwinds coming from the economy to be able to manage their business in a way that is consistent with what the consumers expect, but at the same time have the potential for a sustainable, and that's the definition of quality, sustainable earnings growth. When you put that into context, that's where we refer us to say, look for those companies that allows you to stay invested, that continues to have strengthened the balance sheets, and that will be stronger even if the economy decelerates. So that's a big part of what we have on both, on fixed income as well as on equities.
Can you find more quality, more reliability in corporations versus governments right now?
Corporations have been very disciplined over the entire period since the pandemic. And if you actually look at a big part of the driver, you can see it in the credit market. The credit spreads have been incredibly tight. And most importantly, not only the level, but if you actually see the level of volatility of the credit market, is actually very surprising to just see that even though we have seen all kinds of uncertainty coming from headlines and everything else, we've seen that incredibly, well positioned for high quality companies where leverage has not been high. Obviously there are companies that have done it and that have been in the process of potentially, disappointing in terms of their future. But overall, that quality is being well reflected in credit. When you think about governments, deficits have ballooned, and you actually see what's going on in the UK, what's going on in the United States. Clearly, a little bit of that defense spending as well of capital expenditures that has been positive for the economy. It obviously puts a little bit more pressure on the long part of the fixed income curve. And you can actually see just that level of volatility that we see in the long end of the yield curve.
This is why it's so challenging when you look at what the Supreme Court has in front of them. This could actually impact potentially what bonds do, given the fact that trillions of dollars coming to the United States from tariffs is supposed to be depleting the deficit. Omar, if we were to see the Supreme Court strike down what is going on with IEEPA and the President of the United States, what would that mean for the bond market?
Well, first of all, the things that are actually very clear, the trend for the yield curve is to be steeper. I think we are convinced, in our research that, overall the uncertainty in the long end of the yield curve, will continue. We see that even just in the last 24 hours, where we've seen volatility on the 30-year, yield on bonds, being, quite dramatic. And a lot of that is because inflation expectations, but two is also, what will be the long-term, views in terms of the deficit regarding, to the setup that may happen with the uncertainty of tariffs. It's kind of interesting to see that uncertainty of tariffs, started by affecting sort of the short part of the yield curve and now has been pushed towards the long end of the curve, precisely for what you just described, which is a big part of why, the middle of the curve seems to be the one that has been the most stable. And even when the yield curve, starts to steepen, you can actually still see some stability in that area.
It's become such a consensus trade, at least at the belly of the curve. How many people have come on this program so far this year and talked about positioning in the belly of the curve and not wanting to go out any further?
And this kind of highlights the concern about long-term conceptions of investing, right? How do you invest long-term in a government? It kind of threatens the idea of 60-40 at a time when potentially, if you don't have confidence in a government going out and you're betting on your retirement package, say 10, 20, 30 years out, how does that kind of shift where you kind of mark-to-market things?
Hey, Omar, appreciate your time. Omar Aguilar of Schwab Asset Management there with some important themes. The one you absolutely nailed, I think you're dead on. That's why we've seen the tightness in credit spreads. Or at least it's one of the reasons. Anyway, investment-grade credit spreads haven't been much tighter than they are right now over the last 2 decades.
Yeah, and this is the sort of idea maybe you could see corporations with a better creditworthiness, tighter spreads relative to treasury yields, just based on the fact they've done better with their balance sheets and their business plans than maybe the federal government.
Got some economic data just around the corner, 5 minutes away. Going into it, 10s at 418, the lowest since May. Yields are lower this morning, now by 3 to 4 basis points. With an update on stories worldwide with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Tech industry leaders are heading to the White House today. CEOs from Meta, Apple, Microsoft, Google, OpenAI, and more are all expected to attend an AI event hosted by First Lady Melania Trump, followed by an evening reception with President Trump in the newly renovated Rose Garden. Meanwhile, Republican Senator Tom Tillis says he wouldn't consider a replacement for Federal Reserve Governor Lisa Cook until there is a court decision on President Trump's move to fire her. Tillis, a key member of the Senate Banking Committee, told reporters he doesn't know if the allegations against Cook would qualify as cause. And Yannick Sinner heading to the U.S. Open semifinals after defeating fellow Italian Lorenzo Musetti last night. Now, if Sinner wins tomorrow, he would reach the finals of all 4 majors this year. And on the women's side, Amanda Anisimova beat out top-ranked Iga Swiatek, redeeming herself in a rematch of the Wimbledon final. Anisimova faces Naomi Osaka in the semifinals tonight. That's your Bloomberg Brief. John?
Serious redemption. Very, very cool to see that. Yahara, thank you. Up next on the program, Neil Dutta of Renmark with investors gearing up for jobs data. In a few minutes' time, it's the big one. ADP coming up next.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Historically, what's mattered most of all, it's the growth impulse, it's the inflation impulse, it's a predictable policy framework around monetary and fiscal policy. You know, a lot of those kind of core steady attributes of the macro environment are in historic uncertainty. It means that macro matters more than ever, cannot be ignored.
Mike Powell of BlackRock, in just a few minutes' time, 60 seconds away, a data point you used to ignore. Can you ignore it anymore? Equity futures on the S&P positive by 0.2% on the S&P 500, up by 0.3% on the Nasdaq 100, on the Russell, up by a third of 1%. Turn to the bond market. 2-year, 10-year, 30-year. 10-year bond yields now down by close to 4 basis points, sub 420 at 418. 30-year bond yields backing away from 5% within a basis point of that level in yesterday's session. This morning, down 4 basis points to 485.94. The ADP report lined up. The estimate in our survey, 68K. The previous number, 104. With the number this morning is Mike McKee. Good morning, Mike.
Good morning, John. I'm looking right now at the number. It's 54,000 jobs, according to ADP, comes in lower than the forecast you just mentioned of 68,000 and certainly down from a revised 106,000 last month. So this is not good news for the markets, and it is something that was foreshadowed by Governor Chris Waller, who noted that the Fed buys data from ADP on a weekly basis, and it had deteriorated during the months since the last jobs report. Taking a look at industry by industry, goods producing gained 13,000 jobs, but manufacturing lost 7,000. The gain was in construction of 16,000. And in service providing, we see trade and information services down 17,000, education and health services down 12,000. It's interesting, Omar Sharif of Inflation Insights putting out a note this morning saying, watch that social and education, health services category, because that's been the one that's provided most of the jobs for this year so far. And if it's losing jobs, that is odd, and it is also not particularly good for the economy. Leisure and hospitality jobs made up the majority of the jobs that we got, 50,000 jobs for the month of August. So it isn't an overall great number, and I might just mention the pay numbers that they use for ADP. Job stayers got raises of 4.4%. Change jobs, you get 7.1%, fairly healthy, but how many people are changing jobs these days?
Mike, a picture of the economy over the last 2 days so far this week. Mike, if you put together the beige book, ISM, job openings for the earlier month of July, this data this morning, it's not a great read, is it?
It's not a great read. It basically shows you an economy that is kind of in stasis, not moving forward terribly, not moving back terribly. But the trend is what some members of the Open Market Committee have been talking about, and that would be concerning because the trend is towards slower growth and slower employment growth, which would feed on itself. So we'll have to see what we get tomorrow in terms of jobs and whether that tells the same story. Oh, and don't forget ISM services at 10.
It's an important read. Mike, we'll be back with you in about 13 minutes' time. Jobless claims are just around the corner. Mike McKee breaking down the ADP report. That comes in a whole lot softer than expected. Equity futures stay positive. But, Bramo, this just puts a lid on this bond market, doesn't it? Just keeps a lid on yields across the curve. 10-year yields are down by 3 or 4 basis points.
Yeah, down at the lowest level since May 1st of this year. The irony is, Michael said that this was bad for markets, and maybe in the long term, if there is weakness, this will be. But right now, it is unabashedly a good thing for markets because they believe that it will give the Fed the reason to cut rates and that will be enough to generate some sort of momentum out of this stasis. But right now, you can see this. It's just sort of a grind to nowhere at a time with pricing pressures, and that's what the data is reflecting.
If you are just joining us, welcome to the program. This is how things are set up so far this morning. The number comes in softer than expected on ADP, 54K. The number we were expecting in our survey was closer to 70, 68K was the median estimate. In about 12 minutes' time, we'll have some more jobs data for you. Jobless claims are just around the corner. To discuss this data point and more, Neil Dutta of Renmac joins us now. Neil, welcome to the program. Just offer us your assessment of just where this labour market is coming into September.
Well, thanks for having me on, John. It's cooling, but not collapsing. So I think that's how you can sort of characterize it. I mean, it's a very, very sluggish labor market. And I think what's important is that you know, consumers are telling us pretty clearly that labor market conditions are deteriorating. So if you look at the Conference Board, for example, jobs hard to get, that's climbing. And I think that's important because consumers tend to spot changes in their local economies in front of what BLS statisticians tell you, right? So they know about pink slips being handed out. They see the help wanted signs in their community storefronts. And if they're telling us that jobs are becoming increasingly harder to get, you should believe them. And that tends to lead the official statistics. So, you know, my sense is that there's an ongoing sort of labor market slowdown that's already in train. You know, I heard Mike McKee mention that construction employment rose 16,000 over the month. I mean, it's really hard to see why that continues considering construction activity is continuing to slow down. I mean, we're just coming off a month where building permits hit their lowest level, you know, for the cycle. And so if there's less construction activity going on, there's obviously less need for construction payrolls.
Neil, I'm looking right now at the Russell 2000 futures, and I'm seeing them up on this data. And I am wondering whether you think that the risk markets are being overly sanguine about the scope of this labor market weakening that you see as being something that will ultimately be beneficial because rate cuts can save it. I mean, do you think that that's a sort of overly rosy outlook on things?
Well, I don't think, Lisa, that this is like last year, right? I mean, this is not a situation where some rate cuts are good. I think we're maybe entering a situation where the markets will have to price in more rate cuts, and that may not be so good because what that implies for earnings. So, you know, this is not unusual. I mean, you typically see the markets rally, you know, on the expectation of additional rate cuts. And then when it becomes clear why the Fed is cutting rates, then the markets tend to, you know, get a reality check in that situation. So I'm not surprised by the equity market response, but, you know, I wouldn't say that
basically cancels the risk of a deeper slowdown in front of us.
What you're saying is really important, Neil. Are you saying that the 150 basis points of rate cuts priced in by the end of next year is not enough based on what you're seeing in the labor market?
Yes, that's what I think. I mean, 5 is like a very weird number, right? I mean, it's either too many or not enough. And I tend to think that it's probably not enough between now and the end of 2026. I mean, you have ongoing declines in construction. That's probable between now and the end of the year. You haven't really seen much of an increase in housing demand, even though mortgage rates have declined about 35 basis points over the last, 3 months or so. We had a meaningful juice to the economy from state and local government spending in the first half of the year, adding about 30 basis points to growth. Really hard to see why that continues into the back half. We're seeing lots of news around the country about, budget tightening across state and local governments. And with the labor markets slowing, that means that household incomes are moderating at a time when there's probably some upward pressure on inflation from tariffs. And so that means a further decline in real incomes, which means that consumers are going to have to cut back a little bit more. So, I think the economy is in a very, very rough spot. I think the news is going to get worse before it gets better.
Neil, when you talk about upward pressure on inflation because of tariffs, you have Steve Myron, who's going to be in front of the Senate Banking Committee today, saying on X last night, it's extremely difficult to argue that tariffs are causing any meaningful inflation. How is he going to explain that one to senators?
Well, I think what's more important, because Steve is obviously getting confirmed, I think what's more important is how that argument's going to hold around the table at the FOMC. I mean, if you're making the argument that tariffs are having no meaningful upward pressure on inflation, then that begs the question, why is inflation running above target?